on the podium? All right, excellent. Okay.
Sarah Snyder says hello.
Oh, yeah. I noticed she wasn't on the list this year.
She's busy trying to chase deals.
Good. I'm trying to. Somebody I saw just joined you guys. I thought I read in the bond buyer that maybe some folks from Citi. Yeah. Tell Sarah I said hello. Yeah, so I'll introduce you, and then you'll come up, and then you'll sit down, and Tracy will come up, and then we'll all come up here. I don't know that we have a tent card.
I'll give you names. Hey, how you doing? Is it also possible? Oh, good. The mic is here, so I could switch to this if I want.
Yeah, you said you wanted to roam. Yeah, Jess was roaming earlier. Here, you want me to? You can. All right, let's go ahead and get started back up. If everybody could please take their seats. Hope everybody had a good lunch conversation. I know the one I moderated was enjoyable, so thanks everybody for participating robustly in that. So I'm Rich Reifel. I'm one of the conference co-chairs. I'm on the faculty at the Daniel School of Business at Purdue University. So thanks everybody for being here. I'm going to be moderating a couple of capital markets pricing trading paper presentations today. It'll be the same format that we've been using heretofore, so we'll be a little bit pressed for time. I ask everybody to think of their questions, audience questions in advance, and then we'll send a microphone around to get those once we all assemble up here. So our first paper is titled State Government Trifectas and Municipal Bond Pricing, and that's going to be presented by Angela Gore from George Washington, and one of her co-authors, Rita Basu, is also here. He'll join for our Q&A, and many thanks to Angela for her participation. I was doing a little research, and I think Angela was first at the conference back in 2015, our 4th annual conference at the Boston Fed, so been around quite a while. And our discussant will be Tracy Gordon, likewise a longtime conference participant with Urban Brookings Tax Policy Center. So Angela will come up, present her findings, and then Tracy will discuss them. Now, this paper I have a particular interest in because when I was an investment banker, I had the enjoyable privilege of doing a couple of transactions with entities that had been subject to some enforcement taken over, notably one many years ago for East St. Louis, Illinois, which was pretty interesting. At the cocktail hour, I can tell you all about it. And then more recently, I was actually appointed by the state of Missouri to be the president of a board that was taken over. It was a failing school district, and while I was there as president, we issued some debt. So I have a little bit of personal experience and some professional experience in this. So I'm looking forward to the discussion, and I'll bring up Angela.
Do I just push this button, it switches it? Potentially? I want to start out by thanking Jess because I thought I was going to be the first person to walk off camera. I have a habit of walking and moving around when I teach, so I appreciate not being the first person. This is co-authored work. Rita Basu is also here at George Washington University. 2 other co-authors, Amanda Beck at Georgia State and Kevin Rich at Marquette University. Normally, he's currently in Germany. I'm a little bit envious of that. So let's switch. There we go. So what exactly is a trifecta? So for those who are academically inclined here, we're talking about united versus divided government. That's the term that they tend to use in academics. For the whole rest of the world, which I would argue is probably more important and larger than academics, they call them trifectas. And so the idea is one party holds both the governorship and the state house and the state representative. So it effectively is single party dominance within a state. So our main research question is, how are municipal bondholder yield spreads affected by these state government trifectas? And specifically, more broadly, how does the municipal bond market or municipal bondholders view this one-party state-level political dominance? So why do we care? I don't have to sell you on the first point. So basically, you've got this tremendously huge municipal bond market. At the same time, these trifectas are increasingly common. So in 2000, 25 of 50 states were in that status, 40 of 50 in 2024. From a research standpoint, it's a really neat design. So it's a state and time varying staggered difference in differences design because over time, these are snapping on and snapping off. So you've got a really nice setting that way. At the same time, you've got state governments that have a tremendous amount of control over local governments. And I think as researchers, we often forget that. So states can impose laws, monitoring of those laws, enforcement of those laws. A lot of this affects bondholders. So, for example, whether or not we had a discussion this morning on GAAP, right? So not all states require GAAP. Not all states require audits. Not all states are going to back the munis. Some let them go with if they go into bankruptcy, and others don't. So you stir this setting together, and we thought it was an interesting one to take a look at. So as far as our hypothesis, our main hypothesis is it's basically null because we really did not know what to expect before we started running the data. So on one hand, you could say, hey, this is going to be viewed as riskier for bondholders. And specifically, we're looking at secondary market trades, just so you know that off the top. So states could impose unfunded mandates on locales, so all of a sudden they have to spend a lot of money on things. It could be risky because the locals have less flexibility overall when the states exert a lot of control. You're probably hearing preemption a lot. It's in the news a lot. I don't know if anybody here is from Texas. That's why I got to put up the Death Star here. This is from Star Wars 1. I argued vociferously with my children who kept trying to tell me it's Star Wars 4 or something, but no, it's not. It's the first one if you're in my age group. But anyway, they're calling it the Death Star bill because they could preempt pretty much a lot of things that you don't normally look at. So all these could impose risk and increase yields. On the other hand, there's other research that says, hey, if you've got a state government in charge of everything, they're worried about what's going on with those munis. They're going to also be held responsible for anything that goes wrong, and so they tend to jump in quicker and try to fix things sooner. You could also have selective enforcement of policies that are potentially viewed as harmful. So you could have something that's embedded in a state constitution that maybe bondholders don't like so much, and the states could kind of back off and maybe not enforce it. So overall, we weren't sure exactly what we would find with this. Our data are combined from the MSRB and Mergent from 2005 to 2018. Our main sample is secondary market trades. We've got pretty much everything. So schools, special districts, counties, cities, everything. But we also do additional analysis that looks at all sorts of other things. So for example, we also look at primary market trades and the results are basically the same. So I mentioned that it's a state and time varying difference in differences design, which is pretty nice. So our main variable is a yield spread. And Rita spent lots of time calculating this, so he did both a tax-adjusted yield spread and also the raw yield. We also look at, so this is, trifectas can either turn on or turn off. So they're snapping on and off through time. And so there's this kind of natural control sample here. But additional analysis, we look at just new trifectas and then windows surrounding that to look to see what happens for the new ones. So I'm going to move to this one here first. So this is our basic design here. This is the staggered difference in differences design. There are lots and lots of control variables. You get to be my age and you're in the back row standing. You can't see them, so I didn't bother putting them in here, but they are there. So here's our main variable. Here is trifecta. These first two columns are looking at raw yield. The second two columns are looking at tax-adjusted yield. The first one here is just doing fixed effects. The second one is putting in all kinds and sorts of controls. So you can see that it's fairly consistent here. So we've got a significant 3.5 basis point reduction when these trifectas are in place. And then this is the tax-adjusted yield spread. So I have here that it's between 4 and 20 basis points. That's also considering a stack design that we do that I didn't bother bringing in here. This is looking at when trifectas start. So this is kind of looking at brand new trifectas 4 years before versus 4 years after, and there are control states in here as well for those who are familiar with the stack design. So you can see that it's pretty flat going into the trifecta. Then here's the year of the trifecta, and we find that these effects increase over time. So it gets bigger as time goes on, which we thought was really interesting. The question is why? So we spent time thinking about why this would be, what do we want to study exactly, and we kept coming back to default risk because there's some research studies that suggest that default risk is a fairly big component of municipal bond pricing, so we thought we would focus on that. And so if it's such that this is impacting it partly due to default risk, then if we pick 3 state-level laws that traditionally have been looked at as increasing default risk and increasing the yields, then would we see this effect offset in the trifecta states? So specifically, there's studies that look at municipal bond bankruptcy. So states that allow munis to have bankruptcy, those bonds end up paying higher rates. They're trading higher. Same thing with the limitation measures, and then we also have states that allow direct voter initiatives. So this is the first cross-sectional test then. So the idea is that if our results are at least partly based on these laws, then you're going to see them magnified in those states. So this first column here is if the state allows Chapter 9. The second is they don't allow Chapter 9. So looking at the first then, the trifecta is kind of offsetting that. So normally you would see this significantly positive yield increase in these Chapter 9 states, but for whatever reason, the trifectas are unwinding it effectively. The same is true for the tax-adjusted yield spread. And so, not to gloss over the other results too much, but we're seeing that in the other two cross-sectional tests as well. So something similar. So you're seeing when you've got a state that has high tax restrictiveness over the locales, so they can't increase taxes easily. Trifectas are unwinding that. Same thing with the adjusted yield spread. So that's kind of the takeaway on that. And then same with the direct voter initiative laws. So some view it as riskier because citizens can directly legislate, put things on the ballot. A lot of times those do have to do with tax and limitation expenditure measures, and I'm sure Tracy could elaborate much on that. So again, you're seeing this unwinding effect of the trifectas. So when we get to the Q&A, I really want to hear from you guys because I have one brother who is an investment guy. So he has like 150 clients. He manages, and I said, why are we finding this? And he said, well, if it was me, I'd be worried about a state coming in, all of a sudden they can do anything they want, and they're going to mess with things like taxes and things that are going to make me nervous as a bondholder. But I want to hear what you guys have to say on that for sure. So in conclusion, we're looking at effects of trifectas on local bondholder yields. Primary findings are that secondary market yield spreads are significantly lower under those trifecta regimes. We do a whole litany of other tests. So for econometric geeks, there's lots of fun stuff in there, thanks to Rita. And we're finding that these results are magnified under all three measures that we use. So we're looking at 3 state laws: municipal bankruptcy, tax limitations, and direct voter initiatives. And so overall, this is kind of in our view, it's the first step towards looking at what happens when you've got one-party political dominance in this setting. And see, I have 2 minutes and 20 seconds left, so I'm going to save it for questions. I would normally what I do is I just throw it out right then, but I'm going to gift it to my discussant. Thank you.
Well, it's great to be here. I will also be brief because, like Angela, I would love to hear from the audience about what you think might be going on. Just want to say thanks to the conference organizers for inviting me to discuss this paper. I am a longstanding fiscal and political institution junkie. I love the study of institutions, how they're enacted, what are their effects, do they solve well-known agency problems, trying to get one person to do what you want, basically, between voters and their elected representatives, between the legislative branch and the executive branch, between one administration and its successor, and people who are looking to design optimal institutions at either a national level or a supranational level, thinking of Greece during the financial crisis or the European Union when it was first formed and also during the financial crisis, often look to the state and local sector to inform their design of those institutions. And I do think now that we're in an era of rising interest rates and a growing gap between federal and federal revenues and spending, you're going to see more talk about institutional reform at the federal level, and again, the state and local sector is going to be cool. If you didn't already think it was from Louisa's very interesting lunch and well-attended lunch. So this paper looks at a political feature, unified party control of state government, and how it affects local borrowing costs. The authors find an effect of 40 to 20 basis points in a year based on their sample of secondary market trades for bonds issued by a variety of local governments, schools, special districts, counties, cities, towns from 2005 to 2018. They further break their sample out into states with and without these political and fiscal institutions, including access to Chapter 9 bankruptcy, with and without restrictive tax and expenditure limits, and with and without the voter initiatives. And they find that the results are stronger in states that have those institutions. And they interpret this as evidence that states are either better able to control local governments when they have these institutions, or they're more likely to look the other way when local governments are trying to raise taxes potentially in violation of a tax limitation. And bond purchasers like that added protection. So as someone who cares deeply about institutions, that's kind of where I think the action is. And so I think there are salient examples like the Death Star, where you have state preemption of local authority, but I think that those are often symbolic, things like plastic bags, and they can apply to such a wide variation of activities like states requiring local governments to build more affordable housing, that it's really hard to see sort of one trend when it comes to state preemption. So I think that could be why the measured effects in this paper are actually quite small, 4 to 20 basis points, even though they are statistically significant. So the way that I would redo this analysis, which is kind of what discussants do, is basically say, that's a nice paper, here's how I would actually do it, is rather than splitting the sample and looking at things separately for states with and without these institutions, include the institution in the regression so you can see its independent effect and then the effect interacted with unified government. And in fact, I would also break out unified government by which party it was, because I think you would expect different patterns, whether it's a Democratic or Republican administration. I'd also look at different time periods, and I don't know if this is possible given the number of switchers that you have in the data, but I would think that effects would vary if you're looking at, for example, the period right after the financial crisis. I think Pennsylvania is held out as an example in the paper, and the switch did happen at the height of the recession-induced state fiscal crisis. That was around 2010. And you would also see maybe different effects before and after the COVID pandemic. I didn't get a strong sense of how the institutions were measured. So I think of bankruptcy as more than a 0-1 distinction. I know in some states like California, there's a mediated process, or I think in Michigan, you have to petition the state to declare bankruptcy. So maybe thinking of those categories, or at least explaining what's in those categories in the 0 and 1 buckets. I also couldn't tell, and another discussants also really like it when you cite them, so thank you for citing my initiative paper, which I hadn't thought about in a while. But I wasn't sure if you were talking about initiatives at the local level, which was what I looked at, or initiatives at the state level. And if it's initiatives at the state level, I wasn't quite sure how to understand, is it constraining state spending is good for local borrowing costs because bond buyers are less concerned about the contagion effects of a state fiscal crisis. So I think more explanation, and maybe there was another page of the appendix that I just didn't print out, but more explanation of what's in those institutional variables would be really helpful. But yeah, overall, I think it's a fantastic paper. I just think it's the institutions that matter. And as you said in your remarks, I think it's more clear when you sort of talk about the unified party control as something that increases the likelihood or the frequency of enforcement of those institutions. And you mentioned it's not just these laws, but also regulations, policies, practices. So it'd be really fascinating to extend the analysis to include those and how they're mediated or not by unified party control. Thank you.
We're ahead of schedule. That's great. So we'll take some questions from the audience, but Angela, I had maybe a question or an observation or just something to ponder. Quoting from your paper, local bondholders seemingly view trifectas favorably as reflected in significantly lower yields. So intuitively, that all makes sense, but then knowing the large percentage of municipal bonds that are owned by individual investors, I just wonder, and maybe this is, you can ask your brother this, how many of his clients actually know or care about a trifecta or the structure of government or the political affiliation or anything like that, and how do we get to the bottom of that? The one with the little coughing person.
Coughing, not coffin. Yeah, no, that's a good point, and we probably should think about it a little bit more. So that there's the retail investors, and then there's arguably the institutional investors. So maybe we were thinking more of the latter than the former. But I don't know if Rita has anything to add. You can jump in anytime. So it's the coughing person.
So again, just adding on to Angela's point, right? So and I think, sorry. So most of the sample consistent with what the prior literature have shown is for the retail investors, right? That we have, at some point we did some distinction between the retail and institutional investors, but I think if your point is whether the retail investors is it an awareness issue? Is that what you are getting at? Like, are they practically aware of what's going on at the state level versus the institutional investors who probably are more aware?
Yeah, the crux of the question is whether or not that piece of the market is aware of that, and whether that knowledge finds its way into the, the marginal pricing of the bond or not.
Yeah, I mean, again, like as Angela said, right, so we probably have to think of this a little bit more, but the average retail investors in this market is not the same as what we see in the general equity market, which we see as a mom and pop investors, right? So I was presenting this paper once, right? So and there were like people at all age ranges, right? So sitting in the audience, and then I asked this question, right? So who among you? Maybe I was asking the wrong audience, like are actually a muni investor, right? So usually to even qualify as a retail muni investor, you have to invest a substantial amount in that market, right? So the cutoff is like $100,000 in trades, right? So which is itself is a big amount, right? So, and then we are hoping that they would be more aware than the average mom and pop stock investors who are like investing in thousands of dollars. But your point is taken, right? So the awareness, we are hoping that the retail investors here is practically, even if they are maybe less tech savvy, but they might be more politically aware of what's going on. But yeah, point taken, we need to probably think of this.
Thank you. Questions from the audience back there?
I had a question, just the connection between the trifectas and the amount of debt issuance. Because I guess my intuition would be somewhat perversely that it's not about fiscal constraint or solutions, but that it's about liquidity. And so generally more bonds available, more liquidity, better pricing. So wonder your thoughts or observations on that.
Yeah, I think the question for us was typical in academics, where do you draw the box around the paper? And it seemed like this was the most straightforward box, but I agree with you that maybe could potentially be something we could look at as well. So the answer is I don't know, because we didn't test for it.
Yes, Dan.
A really interesting paper. I was wondering if you can speak a little bit about the maturity results. So one of the things that came up was that there are kind of longer maturity bonds that are trading in these states that have trifectas, but also it seems that the incentives for trifectas to kind of use fiscal constraint or kind of borrow at different horizons are very potentially different than non-trifectas. I was wondering if maybe there's something, is there any information in the maturity of the bonds, or is there any kind of...
Yeah, that's a really good point. So from a design standpoint, we do control for those kinds of things, but we initially were thinking along the same lines you were, and we started out doing different partitions based on maturity and bond rating, I think, right, at the individual bond level. And then we started veering off towards Tracy's point of view in that we started realizing, to us, the most interesting things were the state institutions. And, what does it mean when you've got a trifecta and they can pretty much, they're so dominant? What does that mean? So we pulled those out of the paper, but I think, didn't we find that there's stronger results in the longer maturity and then...
Yeah, if you from that slide, right, so the one you showed, right, so even if from that slide you could see that there is a decrease, like a waterfall kind of a trend, like the effect becomes stronger for over the years, and then longer maturity bonds have a stronger effect. So that's what we see.
So your suspicion is right.
Other questions over here? They'll bring a microphone to you.
Oh, I was wondering if you could address what was brought up during the discussion. Like, did you break it out by party, and did you see any differences between party?
Well, part of it is we're trying to float this to a journal, and we couldn't come up with a good reason why, other than, wow, that would be kind of interesting, wouldn't it? And that doesn't usually go over very well with journals. But we did run it. So what would your priors be? What would you think?
I mean, Republicans might be lower, like on the spreads, and Democrats might be higher.
We found the opposite. So, yeah, but I agree with you. So I hope a reviewer isn't sitting in the audience. We already know the answer. You're going to have to help us about why we would look at it. But yeah, no, I think that could make some sense. We just couldn't come up with a good theoretical reason before the test why we would do it and what we would expect.
So the decline is greater for... Explain the difference.
The effects are strongest in Democrat trifectas.
Probably have time for one more question. Jess?
Hi there. I'm wondering if how you're thinking about potential reverse causality, where voters are surprised and or not surprised, but pleased with the way things are going, and so that provides momentum to one of the parties, and party power consolidates.
Yeah, so one of the ways of handling that was through the stacked event study design. And so we're comparing states that newly initiated a trifecta against states that never had a trifecta at all, and then throwing the rest of the states out. So it's like a really tight research design that way. And the results are basically the same. So
We've got time for one more. I know I saw a hand back there. Great.
Yeah, thanks. Very interesting paper. Just wondering if you considered the trifecta's impact on sort of spreads at the state level and how that trickles down because of the individual preference for bondholders within a certain state. California being a particular case, especially going from multiple parties to one party, fixing their constitution and seeing spreads collapse in a significant way in that way.
yeah, so I think at one point we included the state bonds, but then again, we decided that the state level institutions effects on the local we thought was the most interesting, so we pulled it. But I think the results were significant for those as well. Yeah.
All right. We're doing really
same
well with
reduction.
short answers, so we've got time for one more question, I see from our timekeepers. Any further questions? It's back there.
Since you have a minute, I'm just I'm wondering if you looked at the difference between so there's in policy, a trifecta usually means lots of policy change. So if there's been not a trifecta for a very long time, and now there's a trifecta, then you would expect lots of change, and that creates a lot of uncertainty for local governments. Versus if it's sort of flip-flopping back and forth all the time, then it may be not such a big deal. I'm wondering if you looked at that. And also if you considered, I'm sorry.
Oh, I thought maybe I'd just answer that real quick.
Yeah, yeah.
So we did think about it a lot. We were hoping to find a paper that did it already so we could have some insights for our paper. We really couldn't find much of anything. So looking at it anecdotally, we found a lot of social-oriented policies, like some will come in and do those immediately, but not enough that's systematic that we could point at, unfortunately, and I would love to see a study that actually did do that. But as far as the uncertainty, at one point we, as a specification test, we included, someone else created a state-level policy uncertainty test to look to see, there's all these different things that could be happening, and we had that both as a control and as an interaction, and it was fine. So it seemed like it's not uncertainty leading into why they switched, because when we did that analysis, it wasn't even significant. So, yeah, that's basically the answer I have.
And if we could leave it there, then thank you.
Thank you very much.
Thanks to the panelists. So you might want to use the steps. I don't want to have an accident. Our second and final paper in this session is going to be presented by my Purdue colleague, Sergei Chernyenko. It's entitled Flow-Induced Trading, Evidence from the Daily Trading of Municipal Bond Mutual Funds. It'll be presented by Sergei and discussed by Peter Block of Ramirez.
Well, thank you very much for including the paper on the program. As Rich said, this is joint work with Zoom Doan, who is at Hong Kong Baptist University. And in this paper, we're interested in studying flow-induced trading and liquidity management by open-end municipal bond funds. And the motivation for doing this is that open-end funds are subject to potentially large redemptions, which might force them to engage in fire sales of liquid securities, right? And one example of this happened at the beginning of the COVID pandemic in March 2020, where municipal bond funds suffered about 5% outflows in the course of about 2 weeks. And their sales of muni bonds arguably were a big factor behind the spike in yield spreads on municipal bonds. shown in the right panel, but also in bid-ask spreads, transaction costs, et cetera. And this also can potentially lead to higher yields in the primary market for municipalities trying to access bond financing for their projects, right? And then about a year and a half after that whole episode, right, the SEC came out with proposals for enhancements to open-end fund liquidity framework. There were a number of components to it. The one of most interest to us in this paper is the potential requirement of holding a 10% buffer of cash and highly liquid securities. And intuitively, what that's supposed to do is help funds meet redemption requests without having to sell a lot of their illiquid holdings, right? Having said that, we don't have a good sense quantitatively how much of a deal this 10% cash buffer would actually make, right? So what we try to address, the questions that we try to address in this paper is, first of all, how do open-end funds trade in response to flows? How do market conditions, in particular expectations of future aggregate flows, affect trading behavior? And by trading behavior, I'm going to mean mostly like how quickly you sell in response to redemptions from your investors, and how might larger cash buffers affect this trading behavior? Right. Now, we're not the first ones to kind of ask these questions, but the existing literature most relies on quarterly, sometimes maybe monthly data, right, by looking at changes between the kind of like monthly or quarterly snapshots of holdings. And it suggests relatively little reliance on cash buffers over these kind of periods. It also has limited statistical power to really test for how expectations of market conditions might affect trading behavior, right? So if you go back to the COVID example, most of the outflows were concentrated over a 2-week period, right? So maybe cash buffers don't really matter over a quarter, but maybe they tie you over during the 2-week window of really severe outflows, right? And similarly, if you wanted to understand how expectations of market conditions affect trading during COVID, what would you be using with quarterly data is mostly expectations as of December 2019, which really don't tell you much about trading during March of 2020. Right? And so what we're going to try to do in this paper is bring novel data on daily flows, daily trading activity, and daily cash buffers to try to better understand the dynamics of flow-induced trading and evaluate the role of cash buffers. Right? And that way also try to evaluate the SEC proposal. Right. The way that we're going to do this is basically taking advantage of infrequent trading in the municipal bond market. That's effectively what's going to allow us to figure out trades by municipal bond funds. We can see changes in their holdings, and we can link that to specific transactions in the MSRB data, and that's going to date and time like when they actually traded. Okay. Now, there is a lot of details to the algorithm. I want to give like a high-level overview, partly because we're going to be using this for other projects as well. But we're essentially going to start by identifying changes in portfolio holdings, the way that the literature does it. Then, before we try to match the MSRB, we're going to purge it of transactions by insurance companies, because insurance companies' transaction data from NAIC basically tell you the date and price of those trades, so we can kind of reliably set those aside. And then we're going to run this iterative algorithm that's going to try to identify different types of trades in MSRB data. Okay? And there are basically 5 types of trades that we're going to identify. I'll just give you like very briefly examples of these. And the bottom each time is going to show you all of the potential trades in MSRB that go in the same direction as the mutual fund during the relevant period. Okay? So the first type is a single fund trade where we can confidently link a change in mutual fund holdings to a unique trade in MSRB. Okay? The second type is like split fund trades, where we have a change in holdings by mutual fund matches to a unique combination of trades in MSRB. Right? Third type is like single family trades, where a number of affiliated funds basically combine their trading behavior and it matches to a single trade in MSRB. The fourth type is split family trades, where we have a combination of trades by affiliated funds, matches to a combination of trades in MSRB that is unique. There is one caveat to this, is that we have to allocate these trades pro rata then across funds. Okay? And then the final type of trade that we attempt to match with our algorithm is situations where we match a given fund's trade to a larger trade in MSRB. Okay. Right. This just gives you a perspective on sort of like the amount of how we can explain all of the changes in portfolio holdings. Basically, where our algorithm is able to explain about 90% of all changes in holdings, so the vast majority of trading behavior, we can pinpoint to a specific trade in MSRB. Okay, and so what we're going to do then is run these daily regressions where we look at the dependent variable, say sales on a given day, and we relate it to outflows and inflows over the previous 15 days, the day of the sales, and the next 5 days of inflows and outflows. Okay? This graph represents the results for sales, relationship between sales and outflows. Right? What you can see is that on the day of the outflows, $1 of outflows is associated with about 24 cents in sales behavior, immediate sales. The rest is presumably accommodated as cash, so cash is really important in the very short term. Right? Over a 21 trading day window, which is like about a month, right, $1 of outflows is associated with about 69 cents in sales and 31 cents in kind of change in cash buffer. Okay? We're mostly going to focus on sales, but just to show you results for purchases, over a 21 trading day window, purchases kind of like overall respond similarly to inflows as sales respond to outflows, but the dynamics is somewhat different. Not surprisingly, purchases of bonds are somewhat slower to respond to inflows than sales respond to outflows. All right. And next, we're going to look at the effects of cash buffers. So we're going to create a daily time series of cash buffers by tracking all of the sales activity, all of the inflows from principal payments, interest payments, maturities, et cetera. And we're going to interact outflows on day T with the cash buffer on the previous day. Okay? And what you see is that if you have a larger cash buffer, your immediate sales in response to outflows are going to be significantly less. Okay? One way to put a number on this is that if you're a fund without any cash buffer, basically close to zero cash buffer, you're going to sell about 38 cents of bonds immediately in response to $1 of outflows. But if you have a cash buffer of 10%, you're only going to sell half as much. Okay? And just to note, if you were to use like monthly cash buffers, as the literature would do, it would point to, you would get much weaker results for cash. It would suggest that cash buffer is only half as important as they really are in terms of helping funds manage liquidity. Okay. All right. We have a number of other analyses in the paper on kind of like cross-sectional differences in how funds trade and on which bonds funds trade in response to outflows. But for the rest of my presentation, I want to focus on the effects of market conditions and using COVID as a setting in which we can try to kind of say something about what are the likely effects of requiring funds to hold 10% cash buffers or like larger cash buffers. Okay. So in this analysis, we're going to look at how market conditions affect trading behavior. The two main variables we're focused here is the average market markup. Right? Over our sample period, the average market markup declines by about 100 basis points. Right? And that is associated with about a doubling in the sensitivity of sales to outflows. So as a result of market effectively becoming more liquid over time, funds are these days sell much more in response to their redemptions. Right? The other effect is the expected aggregate net outflows over the next few days. Right? So we have a model in the paper of like predicting what the outflows are likely to be in the aggregate across all funds over the next 5 days. And that has a significant effect on a given fund's propensity to trade today in response to outflows. So if expected aggregate net outflows go up about 10 basis points, my propensity to sell today in response to outflows increases by about 36%. All right. And this explains a lot, basically, of what happened during COVID, right? The left panel just shows, again, aggregate fund flows during COVID. Basically, funds start suffering really large outflows after March 9th of 2020. These outflows are persistent, and so they predict future outflows in the aggregate. The right panel then shows our estimates of from rolling regressions, which use 5 days of data at a given point in time, of the propensity to sell in response to outflows. Right? So early on in 2020, before COVID hits, the propensity to sell in response to outflows is actually relatively low. Once COVID hits, this propensity spikes to and peaks at about 0.5. So for each dollar of outflows, funds are selling 50 cents of bonds right away on that day. Once the Fed starts intervening in corporate and muni markets, kind of towards the end of March and early April, that propensity starts declining and funds are not selling as much. Okay. All right. So we're going to use this episode to estimate the potential effects of larger cash buffers. To do this, we're going to use data through February 2020 to estimate this relationship between sales, outflows, and inflows, and how they're modulated by cash buffers and expectations of aggregate outflows. Okay. We're going to initialize each fund's cash buffer as of March 8th at 10%, and then use the estimates from this regression along with the realized fund flows to basically predict how much funds would sell on each day and how their cash buffer would evolve over time. All right. So here, first of all, the left plot shows the cumulative aggregate sales by all funds during this period. Overall, funds in our sample sold about $30 billion over a course of 6 weeks. Right? The blue line is the actual value. The red line is what happens when we use our model along with the actual cash buffers. So if I use our model estimated, kind of make out of sample prediction, we get pretty close results, right? But when we initialize all funds with a 10% cash buffer, we get less sales, but the effect is actually relatively small. Aggregate mutual fund sales would be only 18% smaller during this stress period. So basically, this suggests that requiring funds to hold such large cash buffers will actually might have relatively limited effect on flow-induced sales. Let me mention 2 caveats to this analysis. It assumes kind of fixed relationship between sales outflows and cash, that it will not change as a result of a policy itself, right? And 2, it doesn't account for the potential effects of cash buffers on redemption behavior. So some people would argue that if you force funds to hold more cash, maybe shareholders will be less likely to redeem in the first place. When we look at this in the data during COVID, that doesn't seem to be the case, that funds with larger cash buffers do not seem to experience smaller outflows. Okay? So overall, our analysis of daily trading and flows indicates much greater reliance on cash buffers than would be suggested by the existing evidence in the literature. But nevertheless, our kind of counterfactual example from the COVID suggests that requiring funds to hold larger cash buffers may have limited effects on flow-induced sales during stress periods. And a lot of this has to do with the expectations of future aggregate outflows. So managing those expectations might be more effective. And finally, just want to say that this kind of daily data, this novel daily data on fund trading holds potentially great promise for other research questions related to trading behavior of mutual funds. Thank you very much, and look forward to Peter's discussion and comments, and for comments and questions from the audience.
All right, thank you, Dr. Chinenko. That was it's an excellent paper, and thanks to the Brookings Institution for having me here. My name is Peter Block. I'm the head municipal strategist for Ramirez & Company based in New York. This is an interesting paper because it proves the details on how some of the mutual funds trade bonds in response to inflows and outflows. And so for my discussion, I'm going to comment on some of the factors that have in recent history created those mutual fund flows and add to the discussion on the cash buffers that Dr. Chinenko was discussing. I'm also going to touch on how yields, absolute levels of yields and reinvestment flows, in addition to mutual fund flows, create trading activity within the municipal market. So I'm going to begin my comments by first putting mutual funds AUM into context. You can see that mutual funds, this second bar off to the left there, it's really the second largest amount of assets in the municipal market, and it's stayed fairly consistent over time at about 18% of assets under management. The largest, obviously, is individual holdings. Within that individual holdings, you have separately managed accounts, which we don't break out separately because there is not reliable data on that. But we estimate that SMAs with municipal bonds hold about $800 billion, which is slightly more than mutual funds, perhaps more. We don't have that data because the bonds are registered in the individual's names as opposed to the SMA managers. And you can see that, the percentages have changed gradually, except for ETFs. Just on ETFs have grown, but they're still relatively small as the overall percentage of AUM in the market. Let's take a look at mutual fund flows since 2008. The paper discussed the COVID period, but there's also some other periods that had their own reasons for dramatic outflows. And we can see that the sharp drawdowns were all caused by specific factors, but at the end of the day, the market did repair itself and healed. The paper concluded how trading in response to fund flows has been heavily influenced by the aggregate market conditions, including the muni to treasury ratio relationship. And as the paper also concludes, mutual fund managers really have less of an incentive to sell when the treasury relationship is distorted, or, and put another way, when bonds are considered cheap in the market, they have much less of an incentive. And the other aspect that the paper discusses in some detail is the propensity for mutual funds and really most institutional investors at that to sell bonds that are more easily traded, more liquid, and that makes sense, until they can't, right? And then they run out of liquid bonds, and no amount of cash buffer or is going to prevent severe drawdowns in those funds. And so just taking a look at the next slide on the top there, I show how dealers have historically reacted to the fund flows. And I talk about dealers because dealers provide an important source of liquidity for the market. And it's notable during the March 2020 COVID era, which you can see I've circled there. And it was during this time that dealers permanently reduced market liquidity. I mean, as you can see, the pre-COVID period, dealer liquidity averaged about $16 billion in their balance sheet. And then post-COVID, there's been a notable switch to about $10 billion on average. And that's due to, some dealers pulling out of the market and just a higher velocity of trading in the market and more built-in liquidity as yields rose. At the bottom here, you can see I put mutual fund flows against trading activity. You can see the COVID drawdown period right here. And then trading flows became elevated, as the outflows subsided, really. And, that aligns with the end of the significant outflow period of the post-COVID period. And it was also coincidental with the run-up in tax-exempt yields and significant losses for bondholders. So as old bondholders were bailing out of the market because they were experiencing significant losses on their holdings, as yields rose, new bondholders came in, attracted by the higher yields. So we can see on this slide, we have trading flows up against I use BVAL, the 10-year BVAL. And you can see how trading was significantly elevated as rates rose. And this shows a significant uptick in activity simply based on the absolute levels of yields. It was about 175 basis points, by the way. The 10-year averaged about 1% before sort of May of 22, and since that time, it's averaged about 275. Okay. And then the other aspect I'd like to focus on is just reinvestment. Reinvestment is a significant amount of liquidity for the market. This is just a pictorial of my forecast for supply, new issue supply. But the blue line represents the reinvestment, and that's principal and interest, and that does not count coupon interest. Coupon interest, I just assume, is used as income for bondholders and is not reinvested, and that's just the assumption I make. But that's just purely principal maturities and redemptions coming back into the market, which is also providing a natural liquidity buffer, which in some cases does add to the cash buffers that Dr. Chernenko was discussing. So in conclusion, I would just want to say, during normal periods, mutual fund outflows are easily absorbed by the funds. Yes, the cash buffer, as the paper concludes, do help to a degree, but no amount of cash buffer during times of market stress and severe drawdowns is really going to make a big difference, also as the paper properly concludes. So that concludes the summary of my comments, and we'll take questions after that.
So, Sergey, not to put you on the spot, but I want to give you a chance to maybe react or respond to any of the observations that Peter made with some of his data, if any of that was instructive as far as maybe expanding or enhancing your research.
Sure, yeah. First of all, thanks, Peter, for a great discussion. I maybe to pick up on just a couple of points. One, in terms of other periods of large outflows, something that we would like to look at in addition. So like COVID was a motivating example, and I think what sort of also motivated perhaps in part the liquidity management rule, the proposal for liquidity management rule. So that's the first place where we started. Can I definitely add kind of more specific cases of previous outflows. And then, yeah, completely, agree on dealer inventories and dealers' willingness to provide liquidity in the market as also being important in addition to mutual fund cash flows, cash buffers.
And so I know when we first talked about this paper several months ago, you said you were yearning for some additional data that was difficult to get. And since we have an audience of people that might be able to provide data, do you want to maybe talk about if you were king for a day, what additional data would you like that you can't get from the MSRB or emergent files?
Oh, well, yeah, I mean, like two things. One is, so there is a limitation to our data in that our daily fund flows, right, come from Morningstar. They don't cover the universe of mutual funds. So, our assumption is that the other one, like operating assumption has to be implicitly that the other funds behave in a similar way, but which might not be the case. But if you have access to data in particular to like Vanguard daily fund flows, would love to have those. And then obviously, any improvements to the algorithm that we could do, the more with that we can identify trades by all of the funds would be helpful. And we're working on partly on incorporating data right now on separately managed accounts. We're not like directly looking at them, but having those in the algorithms is actually helpful to improve the accuracy of the algorithm because the more that you know of all of the parties trading in the market, the better you can identify each individual one.
Great. Questions from the audience? And Dan's got one up here. It's always in the front row. You always got to run that's far from the back to get to the front.
Is it possible to
get granular in the data and discern different funds, different fund families that have the appearance of different strategies in terms of accommodating flows? Like, could you drill down the data and say, well, Oppenheimer tends to do this, Fidelity tends to do that, and discern some fund or fund family or management company level tendencies here?
It is possible, yes. And it's something should be on our to-do list. Yeah. Right now, I will say that we primarily looked in the cross-section. Those were the results that were not reported, which are using like fund size or family size. And other measures of like whether the family has, interfund lending program or lines of credit, but it's not estimating these propensities kind of fund by fund or family by family.
So you actually hit on and you just mentioned the point I was going to ask you about the fund size, if that changes the behavior, and maybe potentially also average rating of the holdings that they have, if you've looked at that at all.
Yeah, so on the fund size, larger funds are trade a little bit less in response, like have a lower propensity to sell in response to outflows. And then we have, in addition to ratings, we have different characteristics of the portfolio. From what I remember, it's actually more important than the rating is the maturity. So the longer remaining maturity of the bonds, the less likely you are to sell immediately in response to outflows. That's consistent with those bonds being less liquid, and so you don't want to trade them as much.
Thank you. Questions from the audience? Here.
Thank you. So I understand that if you look at corporate equity funds, then it's impossible to measure the response of daily trading to daily inflows and outflows because you do not observe their daily positions. But I think there's a recent paper by Don Low at LSE, and he developed a method to back out the daily position of corporate equity funds based on publicly available data. So I think their argument is something like you cannot observe their daily positions, but you can observe their daily returns, and that's disclosed. And they have some algorithm to back out how much each stock an equity fund is holding every day. And I think if you can apply their method, maybe you can measure the response of a corporate equity fund to daily inflows and outflows as well. I think that would be really cool.
Okay. Yeah, this is something that we need to think about. I think what you would need is like really accurate data on the daily returns of individual bonds, right? And then if they don't have transaction prices on lots of days, that might be a challenge for implementing that kind of methodology for inferring daily trading.
Did I see a question over here? Yeah. Behind David. Sorry, David.
I have a question relates to your results on COVID shock. So I think you showed that there's a consistent outflows over a month period, and then the sell to flow ratio goes up to like 50%.
Yep.
And my question is, why it peaks just at 50%? Why didn't it go up to 1? Because I would expect that by the end of the outflow stream, the funds already run up all the cash and they have to sell 1-to-1 to meet the redemption, right? Because 50% means that even till the end of the shock, the funds still have some cash at hand that can meet about half of the redemption?
Yeah, so a couple of things. First of all, that graph shows just the coefficient on contemporaneous outflows, right? If you add up the coefficients on like today's outflows and like the first few legs, you will basically, during COVID, you will get close to 1, right? So they don't sell on that day 1 for 1, but over a course of about a week, they sell 1 for 1. Right.
Thank you.
David, you're up.
I have a policy question. From a financial stability viewpoint, we worry about outflows from these funds causing fire sales. And if I understand what you're saying correctly, having a cash buffer is not a good, doesn't do it, doesn't discourage these sales. So what if anything, do you think we ought to think about as a way to limit the financial stability risk of funds that essentially offer daily liquidity but are holding illiquid assets? Swing pricing, or have you thought about what are the other policy levers?
Yeah, so I think that making shareholders potentially internalize the cost of liquidity that they're essentially requesting through something like swing pricing is potentially going to be more effective than asking funds to say, always carry, right, effectively a 10% cash buffer, which, as we show, at least according to our analysis so far, suggests that it is helpful, but like the magnitude seems relatively small in terms of how much you would reduce total sales.
We have time for one last question.
I just have a quick question about the COVID time. So do you see among those mutual funds in the study, do you see any difference or different actions across different mutual funds? Do they, for example, for large mutual funds, they prefer to hold more cash, or what did they do during the COVID time across funds? Yeah.
We did not specifically look at sort of cross-sectional differences across funds specifically during COVID, but this is something that we can look at.
Great. All right, that concludes this session. Thanks to our presenters. I think we're rolling right into Dan Bergstresser and his panel, No Break. The floor is yours, Dan.
Okay, can you hear me okay? I'm mostly just making sure that, get yourselves reset. And do we have all of our presenters and discussants for this session? Is everybody squared away? Awesome. So this is a panel that has 3 papers. And I was accused to some degree of putting together a disparate, they said, well, nothing really ties these papers together. And I think that's not true. I think as we watch these different papers, the thing that really ties it together is, in different ways, is notions of state capacity, like the ability of governments to execute policy objectives. And it filters through in different ways in each paper, but I think that as a theme for these papers is a useful organizing framework. The first paper we have is going to be presented by Will Nober of Columbia. And we have Laird Brooks of the George Washington University as a discussant. So take it away.
Hi, everyone. Let me see. This is not working, is it? It is. Okay, great. Hi, so I'm Will Nober. I'm a PhD student at Columbia, and I'm presenting work today that I'm doing with 2 co-authors, Zach Liskow of Yale and Kaylin Slattery at Berkeley. And we're focusing on procurement and infrastructure costs. So basically, how states procure and administer the contracts of both small and large infrastructure contracts, and how that and the costs associated with those. So I'm going to start with what's hopefully a not too controversial statement, which is that it's very expensive to build and maintain highways and other roads in the U.S. Great. Okay. It's very expensive to build and maintain roads and highways in the U.S. The U.S. public sector across state, local, and federal spent over $250 billion on this in 2022, the last year we have full data available, and as my discussant has pointed out in astute recent work, these costs have been going up quite a bit over time. The cost of building a mile of highway has gone up over three times since 1960, and these costs are high in comparison to our peer nations. And this is where we're far from the first people to point this out. This has received a lot of media attention, but today we're going to focus on one specific potential or class of potential drivers of these costs, which is the procurement and contract administration of these highway contracts. So public procurement is a pretty big share of U.S. government expenditures, and specific to highway construction and maintenance, it's the vast majority of the game. So most of what you're spending your money on as a state or local government that is building and maintaining highways is hiring a third-party private construction firm to contract this work for you. So there have been a lot of studies that have looked at specific elements of these procurement processes or contract structures in specific states. So if you look at the work of like Greg Lewis and Pat Byery in California and Minnesota, you'll see how they zoom in on scoring auctions or other structures like that. But what there really isn't out there is sort of a comprehensive look across states at, first of all, how costs and returns on those costs compare to each other, and second, on the procurement practices themselves. So that's sort of where we're looking today. And so what I and my co-authors do is we conduct a 50-state survey of state DOT procurement practices. So we went out to every state Department of Transportation. We asked them a lot of questions on what they do in their procurement and contract administration processes. And then we discovered that the other side of the ledger was also sort of missing things. So the question of like how many miles of road are states resurfacing or maintaining every year, and to what extent, how intense is this work? Publicly available federal data wasn't really cutting it there, so we went and collected a bunch of data on that ourselves, and also collected a bunch of administrative data from the census on both the private and public sides of this. And what we found eventually was that state capacity within these state DOTs matters quite a bit. And so to drill down on the role of the engineers at the state DOTs themselves, we went to the state of California and gathered a bunch of even more detailed data on the engineers who administer their contracts and the costs associated with these contracts. And so I'll get to that at the end. And the main takeaways here are that, as I was saying, capacity of state DOTs is a huge driver of project level costs. Pretty much everyone we talked to agreed that state capacity has declined over time, over the past 10 to 20 years, and administrative data serves to confirm this. As we know from prior literature, practices that increase competition across contractors also act to control costs. And what we learned from our investigation of engineers within the California DOT system is that the identities of specific engineers have a lot of explanatory power for cost differences across contracts. So I'll go quickly over what was in the survey that we sent around to state DOT officials and to private contractors. So the survey was about 40 questions long. It tended to take people around 10 to 15 minutes, and it drilled into sort of five key areas that we thought might drive costs in this space. So transparency. So when the state puts a project out for bid, what is included in the documents? Competition. So how many firms are typically competing against each other to win contracts? Quality control. Capacity of the agency and contract credibility. So what that means is when the state publishes plans for the project that the contractors are looking at and then making bids based upon, how much do they believe that these are going to be accurate? And on the other side of the ledger, how much does the state DOT believe that the bid that contractors submit is going to be what they can actually do it for? And then we ask a few questions about corruption at the end, though we find that we didn't get a lot of super useful information here. And we gave them a bunch of time to submit free response answers on what they thought drove costs and their general comments on the process, which were fascinating to read through. We framed the survey around sort of a case study resurfacing project that we thought represented like the modal bit of spending that state DOTs do. And we ended up getting a sample that represented every single state's DOT and and contractors who base their operations in almost every state. The second piece of data that we collected is project-level cost data from each individual state DOT. The Federal Highway Administration does provide some data on how much states spend on highway construction and resurfacing, but they do this through a survey where states have a lot of leeway in reporting, and we thought that the patterns here just, it didn't seem like terribly reliable data, so we decided to collect it ourselves. So what we did was, in some cases, we submitted public records requests. In other cases, we thankfully were able to download data off state websites. But we constructed a subsample of 5 projects in each state that met a bunch of criteria for being a resurfacing project, being straightforward and not having too many other elements of the contract. And we collected a bunch of information on these contracts, such as how many lane miles of road were getting resurfaced, how many bidders there were, what was in the project plans, things of that nature. And the third element of the data for this part of the project is administrative data on the highway construction industry. So we looked at the census ASPEP in the highways category to see how employment at state departments of transportation has evolved over time, and also at the economic census for construction, which is conducted every 5 years and gives account of how many firms are in the highway construction industry. So a quick primer on the survey results is that survey respondents are generally concerned with 2 inputs to the procurement process. So they're very concerned with DOT capacity. There's a lot of talk of how state DOTs are understaffed. The state DOT employees themselves say that, and the contractors say that. And sort of surprisingly to us was the emphasis on consultant use. So everyone across contractors and DOT employees agreed that consultant use for drawing up project plans was both common and drives up costs. So this is a practice that in free response answers we learned was often done by the state DOTs themselves, by experienced engineers in previous years, and in recent years has been contracted out to third-party consultants whose incentives may not be aligned. And admin data verifies that state DOTs have been shrinking in employment over the past 10 to 20 years. So linking these survey responses with the project level cost data that we collected from each state, we found that states that had higher costs per mile tended to also be places where people said that consultants were driving costs higher. And similarly, we found that certain elements of what the state DOTs were disclosing tended to be correlated with costs. So the DOT publishing both plans and unit costs tended to drive costs down. Publishing the estimated contract value tended to drive costs up. And a couple of answers that people gave related to competition also had strong relationships with costs. So the DOT doing extensive bidder outreach was something that was associated with costs being lower, and an answer that subcontracting limits drive costs was associated with costs being higher. So that potentially indicates that these are places where people are facing binding constraints on how much they have to subcontract out. So I want to finish up here with some work that we did on. So like the results so far sort of suggest that there's a big role to be played by state capacity and by sort of experienced engineers in communicating credibly and with the private contractors that are fulfilling these contracts. So we wanted to look at within one specific state how engineers interact with costs, and so from California we got a few different data sets. We got data on all construction projects that they've done from 2000 to 2018. So we have over 11,000 road projects, 2,000 of these being resurfacing projects, with the names of what's called the resident engineer in this data. So this is the engineer who is sort of on the ground interfacing with the contractor. They're not involved until the construction stage, so they're not really involved in the planning of the project at all. And then in a separate data set from 2012 to 2023, We have data on sort of the full evolution of these projects from the pre-bidding stage through construction. And we also have the identity of what's called the person called the project manager for these projects. So this is the state DOT engineer who is sort of managing the pre-bid, the bid stage, and the planning stage all the way into construction. Though from conversations with state DOT, we don't think this person has a lot of involvement in the construction process itself. And we also have bidding data for a few recent years, but we're not using that quite yet. So the variation in our data. So we have so zooming in on just resurfacing projects in the graph on the left, we see that there's quite a bit of variation in cost per mile. This reflects the fact that different amounts of work are being done on different roads. Some of them are in very treacherous places that are hard to get to, and some of them are in urban places that are very expensive to work on because you have to divert traffic and stuff. And also some data on engineer assignment. So we see that people who have more years of experience in this bin scatter on the right tend to be working on projects that have higher cost per mile. So this likely represents selection. This represents that engineers, when they have more experience, are likely assigned to projects that are more difficult to administer. And this is we're showing detail on the resident engineers here. So these are the engineers who are involved with only the construction stage of the contract. But there's still quite a bit of variation in cost per mile to explain here. So we estimate sort of an engineer fixed effects model here. We just take every project, we regress the log cost per mile on a bunch of different fixed effects for the road it's on, for the county it's in, for the year, and for the engineer. And then we shrink those effects because we only have, in many cases, a few observations per engineer. So the estimates that we come up with for these engineer fixed effects are going to be biased away from zero. So we use sort of a small sample shrinkage procedure. And in the graph on the right here, we see our sort of headline result for this, which is that replacing an engineer replacing a resident engineer, not a project manager, at the 95th percentile of the cost distribution with a median engineer reduces project costs by 5.2% or $24,000 per mile at the median. And given that the average project is 9 miles long, this is a savings of $220,000 per project and $13 million per year. And this is work that we're still developing, given that we just got the data in the past couple months. So in this project, this is sort of a wide-reaching project where we're trying to discover what parts of the procurement and contract administration processes drive high infrastructure costs in the U.S. We come up with a few new sources of data to attack this question and find what we think is fairly compelling evidence for two cost drivers being limited state capacity that has been falling over time at these state DOTs, and more evidence that we didn't really get to too much today on suboptimal levels of competition in the market for these highway contracts. And going forward, we're excited to hear everyone's feedback and gonna refine this model of engineer fixed effects more and hopefully learn more about the role of engineers in this process. So thanks.
Hi, everybody. Thank you for having me. It's nice to be here. It's always nice to talk about stuff. So this is not actually what they're talking about, but this is a nice new bridge in DC, which we have recently procured. All right. So the fundamental question in this project is trying to understand, for the same spending on subways, we get in Manhattan a little bit of subways, and in Paris a lot of subways. Why? I think the answer to this question remains still a pretty big unknown. And I think we want to know why, because we want to know what policy changes can lower costs. The numbers here are from an initial project by an institute at NYU that's looking at transit costs, but this problem is not unique to transit costs. We think we see it in highways. We think we see it in lots of other stuff that we build in the United States. So I think this paper is attacking a really important question. What is the policy rot that's going on in the United States that is driving these high expenditures? All right, so toward this goal, here's what the paper does. It asks three specific questions to try and understand what's going on. So the first is, what do participants in this process say? So they survey DOTs and contractors. Then they say, okay, we have some participant opinions. How do those opinions correlate with costs? And to do that, the authors collect cost data and then relate those survey responses to costs. And then the third thing the authors do is ask, well, given some suggestive evidence that these procurement practices relate to costs, we're going to look at actual individuals and relate those individual behaviors to cost using data from California. All right, and then the paper, I think more gently than the presentation, concludes that there are two important things that are driving costs. One of them is state capacity, and the other is an absence of competition. I'm not going to talk too much today about absence of competition. I think you heard it from the treasurers this morning. Everyone agrees that, I think we all know what competition is. We have ways of measuring competition, and I don't think there's really a lot of dispute about whether more competition lowers prices. So I'm just going to pause on that one. So I'm going to spend the most of the rest of the time thinking about capacity. So there is a lot to like in this paper. It's a serious consideration of institutions, both in measurement and in analysis. And I think that's a real strength of the paper. You can see that it likes to take the institutions on the ground seriously and think carefully about what's going on. So rather than tell you what to add to your regression, I have three big picture questions in response to this paper. Not answers really, but some questions. All right, so my questions are: first, what can we learn from cross-state variation in repaving? Second, how do we implement, or where is the scope for change? And then third, what is capacity and what is enough? Please, what is enough? All right, so the first thing I want to talk about is what you can get by looking at cross-state variation in repaving, because that's where this paper's focus is. That's the study it asked the state DOT people and the contractors, and it's the cost data they've collected. And I think it's best to understand the engineering projects they look at. All right, so there are real benefits in looking and comparing across states' repaving projects. First, repaving projects abstracts from a lot of the things that we think cause problems in the United States. Complaining neighbors, sort of NIMBYs in general, something Zach, one of the co-authors, and I wrote about in a previous paper, so the rise of citizens' ability to complain over time. This gets rid of that because mostly people like their potholes to be fixed. And they're willing to put up with a few days of repaving to fix potholes. It holds the broadly, not entirely, but broadly the legal system constant. It holds many contracting features constant because the federal government mandates certain contracting features in repaving that uses federal dollars. And I think this is a plausibly comparable good across states. So those are all benefits of this comparison. But it comes at a cost, which I think the authors could be more frank about, which is that because you're holding all this constant, there's important things that might matter for costs that you don't see any variation in, right? Because you're holding the bidding format constant, you can't tell whether it's the bidding format that's driving costs, because the bidding format is constant, which is fine. I mean, in any paper, you have to hold some things constant, but I think you just want to be clear, like, what's the scope here? We don't know whether the legal regime matters because that's relatively constant. And we can't actually tell from this paper whether repaving is in itself a high-cost activity in the United States. It could be that we're really bad at building roads, but maybe we're okay at repaving. And that's just, I can't tell that from the paper, but I think the paper could be enhanced with some international evidence that would just help us scope out. I think, that's like one day of work that would add 20% to the paper. So, given all that, what can we learn from cross-state variation? I think we can learn the extent of variation within strict rules, which is important. There are strict federal rules that limit the extent of variation that we would expect to see, but if we still see a lot of variation across states, that's important to know. We can also know something about the relationship between spending and road quality, because there's great measures about the roughness of roads that you can use across states. But then most fundamentally, I think what we learn from this context, where we're holding so many things constant, is the quality of implementation. So so many things are fixed. What really seems to be mattering here, at least is my guess, is your ability to execute, your ability to manage and execute within a set of fixed rules. Which brings me to the second question, which is how do we implement well? Which I want to say is not really the heart of success of what economists know about, okay? We know about competition. We're not stars in management practice. So I think, particularly here, we need some help with a framework to think about what implementation is and to motivate the trade-offs in implementation. So this is where I really have a set of questions and not really any answers. So if we're not motivating well, if we're not implementing well, why not? Is it quality implementation? Is it hard to find? Are people who do it hard to find? Are managers hard to find? Does quality implementation only work when you have political attention? And politicians only have so much attention. If they're not paying attention to you, your potholes remain unfilled. Is that what's going on? Are there goals other than cost and quality? I mean, I know that surprisingly, neither the contractor nor the DOT told us the corruption was a problem. But I don't want to say there could be goals other than cost and quality, or is it that we can't implement well without competition, and that without competition the rest doesn't matter? I think those are all possibilities, and they're sort of a frame for how we want to think about going forward. And then, so if that's sort of the framework, the theory part, I want to think about where does it bite institutionally. So if you want to fix, if there's levers here for a bureaucrat to implement or not, where are they? Is it in the initial good design? Is it in monitoring progress? Is it renegotiating with the contractors? Where are those institutional hooks where implementation can matter? And I think this is important because it tells us where the scope for change is, right? If we think that the hook is in the good design, then focus on that in your implementation. And then lastly, what is a high capacity state? I think the paper suggests, and other papers apparently will also suggest, that capacity matters. So I need to know, I think I need a better sense of what capacity is. Is it the productivity of the state employees? And why are consultants not substitutable for state employees? What is it that a state employee gives to the quality of implementation of a project that a consultant does not? I mean, I'm willing to believe that there's something, but I'd like a framework that helps me understand where that substitution is. And can we ever have too much capacity? And if that's all the case, if capacity is so great, why don't we have more of it? And I think that's also where a framework can help us understand what the binding limit here is on capacity. Is it that an incapable state is cheaper, and so sometimes we prefer the cheap outcome rather than the capable one? Or is it that we prefer to consult these less capable consultants sometimes not because they're cheaper, but because we can grow and shrink the size of the sector in a way you can't with state employees? Is it that contractors exert too much influence and this is some kind of political game? These are all possibilities, but I think understanding which ones bite when is important. And which brings us to, so we want to frame it and then we want to measure it. So the current measure in the paper, at least for certain parts of the paper about state capacity, is the number of state employees. And I got to say, this one gives me a bit of hives, okay? I live here in Washington, D.C., where we spend a lot of money on schools. We have a lot of school employees, and we have a horrible truancy rate. I wouldn't say that we have in that regard, we don't have a very capable state, but we do have a lot of employees. So I think a more compelling measure of state capability scales the employees with some outcome. So, what are you getting per state employee, which could be roughness per state employee, the roughness of a road, which is you're getting with repaving. It could be some measure of full-time employees per consultant that helps us get a sense of where the substitutability is. So I think these are all huge questions, which I've given too many to the authors. But I want to give you some food for thought, and I want you to help think about, I think, what the underlying core issue in this paper is, which is implementation. How do we do it well? And how can we, largely as economists and numbers guys, speak to these really important issues of management? So thank you for repaving the way towards efficiency.
Okay, the first thing that I want to do is I want to give you, Will,
a chance to respond to any of the comments if you'd like. Not required to, but.
Yeah. I think, is this on? Yeah. Great, okay. I just want to respond to the last one really quickly on on best ways to measure employment. So unfortunately, the consultants thing, I don't think will be possible to measure because there is no unified sort of data on consultants to state governments, unfortunately. I mean, and I think we do have like a measure of like employees per sort of a bang for your buck measure of employees. I think is a pretty good point. I mean, I think though that I think the gold standard here would be to measure like the average tenure of employees. So a thing that we heard in a lot of our free responses was just that, like long tenured employees were retiring during the 2010s and, not being adequately replaced. And then the people who were doing the contract administration were like very young. And that was leading to issues on the contractor end. So I think, if we were going to go in that direction, I think that's probably where we'd go.
Have you, is this designed with the chance to turn it into a panel? Will you be able to follow the people who responded to your survey over time?
Unfortunately not.
Okay. We have a question. A microphone is coming your way.
So I'm going to piggyback on Leah's comments. I think the question about consultants is really interesting and important. And my guess is you can probably do something looking across states. So, right, one of the reasons Leah suggested you might wind up with a bunch of consultants is that it's easier to scale the size of the total industry. In most states, it's going to be really hard both to hire and to get rid of state employees, and consultants are much easier to kind of scale. But there also are, there are a bunch of states that don't pay their state employees very well. So if you're a really good engineer, you'd rather go work for a private consulting firm where you probably get paid a higher salary. But I suspect there's difference, right? I mean, like California actually pays their state employees pretty well. And so they may not be as much of a pay differential between working for the state and working for a consultant. But I'd be interested if you can sort of look either across states at sort of what the consulting environment is. That's another place where you might have differences in competition on the land use side, right? So like there are places that have a ton of consulting firms. So like the consultants are competing against one another. And there are others where there's basically like a handful of consultants who are like doing this for everybody. And so like the consultants themselves have no incentive or need to reduce their costs. And that's probably something you can look at because my guess is that there's a finite universe of consulting firms that do this stuff.
Likely, yeah, that's a great suggestion. Thanks.
Okay, I've got a question for you. And I know, so you're a PhD student at Columbia. You spent last year on leave working at the White House and the Council of Economic Advisors. Were you thinking about infrastructure, like in that role there, what's going on in the administration thinking about infrastructure? Or was that your job there, thinking about the cost of infrastructure?
I was working more on renewable energy this past year, but I mean, so one of my co-authors took this to a working group at the White House last year, and I mean there isn't that much for the federal government to say here because this is all like these are we're looking at like our variation is the decisions that that states make within the very confining strictures as Leah said of federal aid highways. So the vast majority of the resurfacing projects in our sample are on what are federal aid highways. So even though the states own the right-of-way and are responsible for maintaining the roadways, the states do not bear most of the cost of maintaining them. So these are non-interstate highways that have like an 80% federal cost share in their maintenance. So the state is only contributing 20 cents on the dollar for every dollar of maintenance, and there's already a lot of prescription as to how the state has to administer these auctions, and how the state has to sort of administer the contract. So, I mean, we didn't really get into our discussion of DBE in this. DBE was a fairly often cited cost driver.
What you have DBE? What does that stand for?
Disadvantaged business enterprise. So like like requirement that like you subcontract a certain percentage of your contract to a firm owned by an owner from a disadvantaged group, and you know that's an area where like you know there has been sort of you know like the federal government could continue to play like a bigger role in either creating or getting rid of additional regulation, but you know it doesn't seem to be super active these days.
Hi, I really like your survey part where you asked about corruption. I was wondering if you have ability to measure corruption in your data, so you could try to see who if the contract is widely advertised and who ends up with a contract, if it's somebody connected to the local government. I imagine you would probably find something to that extent sometimes.
Yeah, I mean, it's fairly hard to measure like how close a contractor is to the state government, especially at the scale that we have to measure contracts. So you know, we're looking across all 50 states and often just at like a big spreadsheet of like the name of a construction firm and you know not really much else. So we don't even know who the owners of these firms are, unfortunately. But yeah, I mean, I would love to dig into that further.
So you mentioned that 80% of the cost comes from.
Sergey, you may want to wait for a mic. You may want to wait for a mic, Sergey, so people can hear you.
You mentioned that 80% of the cost is covered by the federal government. I'm curious whether that also applies to the consultants and sort of going back to the employees versus consultant issues, whether the reason to employ consultants if the federal government picks up 80% of the tab for the consultants versus if it's your own employee, then you have to pay a whole salary for your own employees.
That's true. I mean, you know, this is the way that federal funding works here is that states get big block grants every year from the federal government. So you know the state does have a finite pot of money to spend. So like it's not sort of like a you know cost plus reimbursement. So I don't think the incentives are terrible there.
Were there any truly? I mean, is that?
So thanks for sharing that information, especially on a by-state basis. Very, very interesting. I was actually just curious, you know, these investments that are made to repave our roads or, you know, investments in public infrastructure, right? So do you have any plans to kind of expand that to an evaluation measure, maybe, you know, like return on investment, just to see, you know, because the Texas road, for example, in Dallas-Fort Worth, has a significant amount more of wear and tear as well as use as, you know, maybe a more rural part of the state. So just curious about that.
Yeah, I mean, we don't currently have the ability to sort of measure the return on that. You know, if we were to continue collecting data, we could see when the next time that like the state needs to repave this road is. And you know, other authors are working on sort of more detailed nationwide measures of road quality. So you know, you could assess that as part of a panel. But I think within the scope of what we've done so far now.
A final question. This is a really nice presentation. Thank you so much. I really like the exercise of trying to decompose the variance a little bit with the fixed effects on the project engineers. I was wondering, and so you have, of course, this small sample size, and that if you only measure someone a few times, there's some potential that you're mismeasuring their actual mean effect, and so you move back towards zero. But there's also a lot of scope for selection, and that it seems if you're really good at your job, you should do it more times, and if you're not good at it, you probably might be moved to another role or something like that. And I was wondering, do you have a sense in whether this shrinkage adjustment you're doing is a little bit overly counting less variation here among engineers than there actually might be, and how you might think about that selection?
So you're saying our shrinkage measure is you're suggesting that it's too harsh? I mean, that would I don't quite know how we would capture that. You know, we could look at, you know, what you're suggesting, you know, engineers getting reassigned elsewhere within Caltrans and see if that's happening. I mean, statistically, I think, you know, that means that we're underclaiming, which is probably fine. In that, like, we're not claiming an effect that's not there. But yeah, no, happy to talk further about how you might think that would go.
Thank you very much. I hope you'll join me in thanking Will and Leah. And we are ready for the next panel. Are you all ready? Great.
Hello? Hello? Okay. You can hear me? Okay, so first of all, this is joint work with Filippo, Marco, and Tom. And the views expressed here. Oh, okay. And the views expressed here are our own and not those of the Fed. All right, so this has been a really fun paper to work on. Let's see. Is it stuck? Oh, yeah, right here. Okay. All right, perfect. Sorry about that. Okay. So this has been a really fun paper to write. So you may have read, you have a ton of cyber risk like lately in the space, in the state and local space, right? So why is that the case? Hello? Yeah, I don't think it's, I think it's like. Thank you very much. Thank you. Okay. All right. So as I said earlier, like you have a lot of space in the state and local. You have a lot of cyber risk in the state and local space. Why is that the case? Well, like states and local entities are very attractive cyber targets because you have substantial information that is being stored by them, right? Like you have a high degree of PII. And like on top of that, the second major reason here is that they have inadequate cyber security. Why is that the case again? Well, this is because they don't have enough resources to like spend for cyber defenses. Okay. So that's very important to a study because state and localities operate our nation's infrastructure. And like cyber attacks have the potential to cripple the nation's infrastructure. What we do in this paper is we look at one type of cyber attacks. So we don't claim we look at all of them. But the one that has been happening most often, which is external data breaches, right? So these types of attacks usually access the network of a state and local entity and like steal information. So like in one way or another. So I'm going to talk throughout the talk about this. So these data breaches have the potential to impose large welfare losses, and like some of these losses could be grouped into 2 or 3 major areas. These are remediation and litigation costs, and you could also have other types of negative externalities like leaked PII. Might lead to more fraud on top of like what we said earlier. So what we do in this paper, this is a very simple exercise. We do a lot in the paper, and I think we have another draft on the way that is going to do even more. But in the most simple terms, we look at the effect of data breaches, and like again, these are outside external data breaches. Where you have a cyber actor from outside of the organization is able to gain access to the internal networks of the state or local entity. We studied the financial costs of these external data breaches. So the first way we assess these type of costs is we look at secondary market returns in the muni bond market. And so what we find there is an increase in financial costs. We find about the same type of increase in the primary market as well. So we have like another mechanism there. And the second part of the paper, what we do is we look at how like implementation of state laws that attempt to lower cybersecurity risk among these entities affect like first cyber attacks and second the spending on potentially like cybersecurity defenses among those entities. The laws that we look at, there are two types of laws. There's data breach notification laws at the state level that were implemented for most states from 2002 through now, more or less. And then the second type of laws that we look at is data security laws, which mandate some form of like at least base cyber defense like set up at the state and local level. So for both of those groups, we don't find any like effects whatsoever on the future incidence of cyber attacks. We find some spending like results, but they're not like they're not stable, so I cannot really claim too much there. But overall, we find that like incentives to beef up cybersecurity may still be insufficient in this space. Okay, so let me go straight into this. So we get data from a number of sources. Our major data set comes from Advisen. So these data have information on operational risk incidents. This is where we get external like cyber attacks. So in this sample that we use in this draft of the paper, we have over 1,000 entities being attacked, and which amounts to about 2,200 outside data breaches since 2004. In the newer draft of the paper, we have even more, since we have a much bigger set of entities. So the next thing we do is we bridge this to the census or the annual like survey of state and local government finances. We get primary market data from Mergent. The secondary market data comes MSRB, so all standard like sources. And then for the final part of the paper, we hand collect data on like state laws from the NCSL and LexisNexis. We got like enactment effective dates for those laws. We got a type of entities that they cover, so it has been like really a lot of work to get all of this information like in one place. Okay, so let me show you just real quick what the risk of an external like cyber breach looks like. So we have two charts here. The left panel shows you the risk of a cyber attack across like the size of entities. So we split entities into 5 size groups. The lowest quintile based on revenue of the entity, you can see on the left side, and then the top quintile, which is the largest entities, you can see like here on the right. So you can see that a larger entity is a lot more likely to be attacked. The annual likelihood that you get attacked is about 2% in the top quintile, and it's like less than 30 basis points among the smallest group. You see like among the same sorting in terms of type of government. So you can see like cities, counties, school districts, special districts, and counties. So here you can see that generally larger entities are more likely to be attacked. So this is not an independent chart from what you see on the left panel. So we don't have the state entities here since they're attacked very, very often. So the bar there would be 50%, like basically of those are attacked on an annual basis. So this is informative. I mean, at least I learned from this, right? And just one caveat here I wanted to like bring up. Recently, the smallest entities have been attacked more and more often. So these things could change actually if you were to use more recent data. So our sample ends in 2019. Okay, so the first thing that we do here is we look at abnormal bond returns around cyber attacks. To be more specific, around the notification of those attacks, right? Because if a market is not aware, like it's hard to really tell what the reaction would be. So what we do here is we use the method of repeat sales regressions. We follow this really nice paper by Kornagia Hunt Nguyen from 2022 to get to abnormal returns. We view this test as more informative about what the effect ultimately is on the muni bond market, since primary market issuance is less frequent, and this is more representative of what things could look like. Of course, liquidity is an issue, and I think some bonds don't trade at all. So I think we may be understating, results ultimately. Okay, so we have these normal returns, and then we compute them within the 30-day window around the notification of an attack. And what you can see here is that we have abnormal returns of about 16, 17 basis points. If you convert this to a 10-day return, it would be about 5 basis point return. So it's not huge, but it's also not very small. So I think it's economically large, to say the least. We'll look at how this risk varies in terms of the type of bonds affected. We find similar effects along revenue geo, like the standard suspects in the space. Seniority-wise, we find smaller abnormal returns among the senior bonds than subordinated, but they're very close to each other still. So you can see that both groups are affected. In terms of the entities that are affected, you see that you have more of an effect, even though not statistically so, among the entities that have higher attack surface, like county governments and state governments, than for the other ones. But again, this is a highly speculative statement, since these returns are not significant from each other. Okay, so we find similar effects in the primary market, which I don't have much time to cover now, but I wanted to get to the most interesting, from our point of view, results. The state laws and how they may affect cyber risk, in the space. So this is the most common laws in the space, data breach notification laws. So those laws require state and local entities to tell the parties that are affected by the breach that they have been attacked, and to shield them from some legal liability if they do so. So what you have here is that the main goal of these laws is not to beef up cyber security, but nevertheless, you may have an effect where state and local entities do beef up cybersecurity to avoid the litigation costs, right? To be able to at least detect cyber attacks. So most of these laws have been passed in the early 2000s. You have some of them have been passed more recently. So basically, this is exactly the type of space where you could argue there's role for regulation, right? The higher financing costs, they attract resources from the community. The loss of personal information could actually lead to more fraudulent activity. So these could really be helpful. So we use the Horusiak-Jaravel Peace estimator here to get the two-way fixed effect estimates. And here's what we find. So we find more or less no effect on cyber attacks, on future cyber attacks. So in the end, I don't think these laws have led to much of an improvement in cyber defenses. In terms of the spending, we don't find very much either. On that end, Now, the second type of law, which has been more recent, the data security laws. So those actually have like very, very specific requirements for state and local entities to like strengthen cybersecurity. The state sets up an oversight body that sets the standards, conducts audits, and employs training. And so here, like, you have more of an incentive that could be at play. So let's see what happens. Once again, we don't find very much. Whether these laws apply to local entities or whether they apply to any like state or like local entities, you find about the same chance that basically after these laws, like the risk of a cyber attack is lower. So, okay, so let me talk a little bit about, that's like my last slide here. So data breach notification laws and data like security laws, they don't ultimately lead to better cyber security. So there's alternative incentive schemes, like maybe one could give safe harbor against data breach lawsuits if an entity, whether that's a state or local, complies with industry norms about cybersecurity. So that could be more like effective here. So a few states do like exactly that, but it's not widespread yet in the space. So let me conclude. Significant costs of low cyber security. We find that data breaches lead to higher financing costs for state and local entities, and this is on top of like fraud that these incidents could lead to. And so far, the state laws that are in place do not also seem to like beef up cybersecurity to an extent that we can observe. Thank you very much.
Is it on? Is it on now? Yeah. Hi, I'm Anna Sherbina from Brandeis University, and I would like to thank Dan for asking me to discuss this paper. It's a very nice paper. And I will talk really mostly about cybersecurity, but let me just start summarizing again the results in this paper. So the paper gets data breaches from the company called Advisen. And they mainly focus on data breaches. So they have over 2,500 observations of data breaches experienced by state and local governments. And what they find is that municipal bonds are affected by the news of data breaches. So muni bond yields, prices decline by 15 to 22 basis points on the news of a data breach. And actually, Ivan didn't talk about this result, but when new bonds are issued in the primary markets, they have to be offered at yields which are 10 to 13% higher. So the cost of municipal borrowing does go up as a result of data breaches. State and local expenditures increase as a result of potential lawsuits and the cost of maybe hiring cybersecurity consultants, revamping the IT systems. So expenditures go up by 5% in the next year up to 3 years. And the interesting result is that the adoption of state data notification, data breach notification, and data security laws doesn't seem to have an effect on reducing the probability of a future data breach. So this is a very important study that shows that cyber risk affects not only corporations, but it also affects state and local governments by increasing their borrowing costs. So I guess when I was reading this paper, it's very interesting. So this paper is really about how our personally identifiable information, our PII, is not being safeguarded by state and local governments that collect this information. But at the same time, for my other research, I actually work with that data, and I know the state and local governments sell this information. So it's actually very easy to buy it. And a lot of it is actually available for free. So if you want to look something up, it's online. And then if you want to pay public records, you could actually pay a little bit and get more, get pretty much what you need. So I pay through Brandeis for my research project, and I'm not really the only one. A lot of people in academia pay money, and they get all kinds of data through LexisNexis, similar companies, public records. And so what data do we get? So people get data on CEOs, I get data on mutual fund managers, and there are all kinds of papers that you see use this data. You know where the people live, what kind of properties they have, how much they paid for them, what taxes they pay, what the assessed values are, what the loan amounts are from which banks, and you could see the children that people have, how many children, when the children were born. So there's all kinds of information that is available. And I'm not really sure if really it's the state and local governments necessarily they sell, all this information. Some do, maybe some sell less. So there's marriage and divorce records that are being sold by some states. And there's definitely more. So where this information is coming from? Bankruptcy courts, there's bankruptcy records, there's criminal records, all kinds of information that you could just buy. You don't have to steal it. And recently there was an article, I guess it was in the Wall Street Journal, how the US government actually buys all this data on US citizens. And the question is it legal or is it not? If the data is for sale, why should I be able to buy it for my research, but the US government should not be able to buy it? And let's say China should be able to buy it or anybody else. So there's really a lot of data which is available for sale. And we know that DMVs actually supplement their income by selling driver's license data. So you could actually download some driver's license information. You could, in some instances, know the person's height, their eye color, etc. And obviously not all of this information is being sold, so I think that's what I want the authors to think more about. So Ivan maybe and the co-authors should think more about what is the data that's not being sold that maybe the hackers want. So maybe there's credit card data, maybe there's health records from municipal hospitals. So I think maybe that's the data that is valuable. So which type of data is being hacked and sold, and which type of data that is then disclosed and would potentially lead to lawsuits in the future and higher costs for the government because of those lawsuits. So another part of the paper that actually Ivan didn't really get to talk about too much, but I think that's really interesting. They don't only study data breaches, but they also study ransomware attacks. And compared to the number of data breaches, which is over 2,500, the number of ransomware attacks is very small in the data set. It's only 235 observations. And to my surprise, they didn't really find as strong a reaction of bond yields to ransomware attacks as they found to data breaches. And what I think is maybe their data set is too small, because what is in the news, we all know of really devastating examples of ransomware attacks, that the whole city of Baltimore was paralyzed, Atlanta, then Baltimore experienced another attack. And in the New York Times, there was an article just outlining the costs, and those costs are in millions, in tens of millions. So those could be very costly. So perhaps if you choose to also study ransomware attacks, I think you will find that the costs are potentially higher, and the number of ransomware attacks is actually increasing over time. So I have a paper on different types of cyber incidences that companies experience, and this is the price reactions in the first 3 days to the different types of cyber incidences. And what I show is that the price reaction to PII theft is only significant because it's very prevalent, but it's only 0.33% in the first 3 days or so. And the price reaction to a ransomware attack is much stronger. Companies lose on average 1.2%. So I wonder if you had a more representative data set, you will find a stronger reaction. Maybe some of those ransomware attacks, they're quickly resolved in your data set, so they're not really a big deal, but I think somehow the public perception is that those are more damaging than data breaches. And I think what is the worst case scenario, and that's really not in your data set, and which is really great, but it already happened, cyber attacks on municipally owned critical infrastructures. Municipalities own water treatment facilities, they own power generating plants, they own different types of physical assets that if they're attacked through cyber, they could cause large devastation and a loss of lives. And it hasn't really happened too much. It was not so much in the public domain in the US. So the only publicly disclosed instance that we know about, or that I know about, is the cyber attack on Tipton municipal utilities by Russian hackers that messed with the industrial controls of the water treatment facility. But that was quickly resolved, so the citizens of that municipality were not affected. But in fact, I think there are many, many more than exist in the public domain. And Joe Weiss, who often speaks on cybersecurity of industrial controls, he collected a private data set on different cyber intrusions experienced by critical infrastructures through cyber attackers accessing industrial controls. And maybe if you talk to him, maybe he'll share some of the data with you, but who knows, maybe he won't. And actually, if those things are not in the public domain, maybe you won't really find a reaction there. But this is the one attack the Tipton municipal utilities that you may look at. So going back to your paper, so I have, this is a really, really well done and very careful paper, but I have some suggestions. So for example, when you look at instances of PII theft, maybe you could look at how severe those instances were. What kind of data was stolen? Maybe it's credit card, health information, so those would be more severe instances. This is the information which is not in the public domain. You could probably get in your data set the number of records that were breached. So again, that would indicate a more severe type of incidents, and that would have a stronger reaction, lead to a stronger reaction on yields. Also, you may look across the bond categories, the lower rated bonds, and I know from talking to Ivan, it's hard to know from credit ratings, but the bonds which have lower ratings that should be more affected. In terms of this part of the paper that Ivan did not really get to present on the effect of cyber attacks on the primary markets, if you were to restrict the analysis on predicting when the governments are likely to issue a new muni bond, for example, when the old bond has expired or is close to expiration, and you're predicting it's very likely the muni government is about to issue a new bond, are they going to delay the issuance as a result of a cyber attack? And also you could look at the local populations, people, retail investors who are more likely to buy and trade those muni bonds. If they are more educated about IT and cyber, is their reaction going to be stronger? And since Christos was here and he sent me a very nice paper, I wanted to mention his paper. And it's actually a nice paper in that it confirms results in this paper. So instead of looking at cyber attacks on municipalities, he just looks at cyber attacks on any entity that is located in a given municipality. And what he and his co-authors find is that when there's any news of a cyber attack somewhere close in the vicinity, the prices of bonds react. And they react in the, secondary markets and also in the primary markets. So that confirms the results in this paper. And just to summarize, this is a really valuable contribution to the literature on cybersecurity and to the muni bond literature. Very carefully done paper. It's very convincing. And maybe as the data set of cyber security breaches increases, you could include in the future, maybe in subsequent research, more different types of cyber breaches. And I would really recommend reading this paper. Thank you.
Okay. Well, can you all hear me? Okay. Everybody hear me in the back? The one thing that I was wondering, watching you present the paper and reading this paper was the use of notification rules as something that predicts. Are we aware? If we don't observe that the frequency goes up after the notification rule comes into place, to what extent should we be worried about it was always happening, or this is actually affecting the occurrence, but the notification rule itself is affecting the likelihood that we're aware of it, conditional on it occurring in the first place? That there could be some, the underlying propensity of cyber attacks to occur is going in one direction, but the notification rule is affecting the probability that we're aware of it, conditional on it happening in the first place.
Yes, so that's a very good point, Dan. Okay, here. All right. So I always have issues with the microphone. All right. So that's a very good point, Dan. I think that could be the case. I mean, I guess you're saying that they could really improve cyber security, so you could see less cyber attacks. But now, because they have better way to assess whether a cyber attack occurred, sure. I think that could be the case. So we can address maybe your issue in a non-direct way. We are now using Lightcast data to see if they hire anybody after a cyber attack. We would look at handing and how that changes around cyber attacks and stuff like that, which, I mean, of course, that could mean a lot of things, but I think there is at least 3 or 4 ways. I mean, with the job postings, if they hire more experts, maybe that's a likely explanation then. But yeah, so unfortunately, that's tough to tell with the data like we have. Right, because seeing the cyber attack, you need to at least have some capability to assess whether a cyber attack occurred. Maybe another way to get at your issue is look at the larger cyber attacks, right? Because there is no way to miss those, which kind of makes me think about Anna's point, right? Where ransomware could be a nice way to look at this. Just wanted to say we have a new draft that's going to come very soon, and there we have a larger sample. The main reason that in the sample that you read, the paper that you read, ransomware has a lower abnormal return is because we don't have state entities very much. And now with the larger sample, we have state entities where we can see a lot of a cost there, higher cost there, yeah. But yeah, so maybe we can look at subsets and we can alleviate your concerns in that way.
Got a question in the front. Why don't you wait for a microphone so that people can hear?
Thank you. Great presentation, by the way, first. And I have a 2-part question. Just first is, if within the data that you have, are you able to identify or you hear your thoughts about the magnitude of the, the data breach and the type of it? I'm trying to think of that. If we expect differential effects of if there is a cyber attack in the, police department versus the Department of Transportation, where arguably there could be different implications in terms of which how investors react to it. And the follow-up would be if the theoretical frame through which we can think about this is if investors are reacting to maybe, let me say, the crime part of it, if this is equivalent of the risk premium that we observe in bonds because there is an increase in crime in the jurisdiction, or is there maybe a story of weaker institutions, and investors are reacting oh, the government is more prone to experience cyber attacks, and this signal that maybe there are a deterioration in the institution. So just wondering how were your thoughts on these 2 points?
Right. Okay. So those are very good points. Anna also did touch upon those. So we can do that, and I think this is part of what we're doing right now. So we have a text blob that kind of explains what happened, who was attacked, how much information was affected. So this is a must for the next draft of the paper, and we'll have that. I think, to your point and to Anna's point, we need to split the sample along that dimension. Now, your point about who gets attacked, yeah, to some extent, you have the weaker entities do get attacked, are more likely to be attacked. But in terms of when you take a large enough sample, that doesn't seem to be the case. It seems like everybody gets attacked at some point. And I think I want to into to the pre-trends there, we don't find very much of that, right? And for the abnormal returns, just so that we can take care of some of these concerns, we now in the new draft of the paper, we're going to build a group by like excluding entities that were ever attacked in the past, and so we can we find about the same like results there. But I'm sure like we can do a lot more. We can talk after to the session.
Two questions. One, how do you think or deal with selection in terms of which bonds trade around these events? I'm worried a little bit whether you are overestimating the effects, because for municipalities for which the effects are small, you're not going to observe any trading, and so you're kind of like excluding their returns from your analysis. The second and somewhat related question is, like, how do you think, what role do credit ratings play in this, in a sense that are the returns driven by changes in credit ratings? So is the reaction is because of the views of credit rating agencies that this is something that they will cause them to downgrade? And are the investors then reacting to the downgrade or to the sort of the information that they get just from the incident itself?
Okay, so very good points as well. So for the secondary market returns, you can make the opposite argument as well. You could argue that the largest entities are more likely to trade on the secondary market. So I think those are the ones that you would observe there. So you can measure returns only for the larger entities that are liquid, that are more like liquid. But yeah, I mean, that's an issue with the data that we have. I think we can expand the window. We can expand the window, but then I think when you do that, then these results become less reliable, right? So you have a cost, but we can certainly expand it to not a 60-day window, but to 120-day window or so, and then see what we find along those lines. We can also look at the larger cyber attacks so that we make sure this is not contaminated by something else, like, you know. For your second point, ratings, sure, that could be the case. We can easily like check that. Ratings, again, in this space, they're heavily tilted towards the A group. So I'm not sure, like, I'll see much action there, but I can try.
Yeah, two quick points. Yeah, so I wanted to affirm the intuition that both you and Anna had commented about around media, and there might be some complementarity so that you don't have to go through the hassle of collecting the data. But basically, we found that media was a propagation mechanism. So investors are looking at things that catch people's attention in the headlines. And then also consistent with what you said around using Lightcast data, we found the effect concentrated in the areas that were kind of short on cybersecurity workers, and then seeing an increase in cybersecurity job postings after data breaches. The question that I had, or maybe kind of like a suggestion, is like, because the advising data is very unique, it's better than like just say PRCD data. You might be able to exploit, you might be able to use the variation in state laws to see what is being reported in advising versus what was just publicly reported in PRCD, if that makes sense, and then that could be a proxy for.
Right. We did this exercise when we first started to work on this, and we found that you have a lot more like in our data than you can find in any other source, you know. So that's kind of nice, I think. I mean, you can see this by the sheer count, but also like you have like a very detailed like summary of what is going on around the like attack. Yeah, so that's a good point. Yeah, I mean, I think this is separate from corporate attacks, though, right? The ones that you look at. I just learned of your paper, so I would have to look at it and I would have to read it like carefully. But yeah, so this is a separate though from like a corporate attack, and we don't rule out a separate channel. But we did check whether they occur at the same time, and it's actually rare. Right, these attacks on state and local are separate from attacks on, like, you know, corporate entities.
Okay, I hope you will join me in thanking Ivan and Anna. So thank you so much. We're gonna
We're going to transition now to the final paper of the session.
All right. Hi, everybody. My name's Alex Butler. I'm from Rice University in Houston, Texas. Everybody who lives in Houston, Texas is acutely aware of the prospect of climate change. We have been living it over and over and over again for about the past decade. So this is Hurricane Harvey, for those of you who are unfamiliar. And you know, I wanted to have some thought as to how does climate change impact municipal finance, and then what can we learn from the municipal finance markets about climate change, and that's what the paper's about. We're not the first ones to look at muni yields and climate risk. There's a variety of papers that do this already. So looking at, say, sea level rise, or sea level rise in a more granular fashion, or looking at heat stress exposure of areas, looking at how sea level rise exposure might affect property values, mortgages, et cetera. And so the problem is that these physical risks of floods and heat and wildfires and things like that capture only part of the problem. The other part is the economic issues, which is the transition risk. When cities or municipalities need to evolve into a area that can more suitably sustain climate change effects, how much is that going to cost? And how can we incorporate those effects, which seem like they'd be difficult to measure, along with the physical risks, which maybe are a little bit more direct measurement issues? How can we combine those two? And that's where our paper comes in. We are going to form what I like to think of as a holistic measure of climate risk that is felt by cities, which we're going to infer from how the municipal bond yields of those cities respond to climate news. And so the paper is one of three parts with two bookends. And so the front bookend is recognizing this fact that we need to measure transition risk and physical risk. And then part one of the meat of the paper is the implementation of how we're going to do this and some baseline results. And I'll go sort of quickly over that. If you want the nitty-gritty details, the paper's online. From there, I'm going to go into validating our measure, comparing it to intuition and also what we already see in the literature. And after that, the implications of this, looking at how these city-level measures of climate risk vary based on things like demographics and geography and who lives there and what those people think. And then the back end is and we also did all the other things that you want us to do that no one ever actually wants to hear, except for the people who are like really, really deep in the weeds. And for that, I'll do some hand-wavy stuff. So that's the plan for the talk. All right. So do we expect that the effects of climate risk are going to be different for cities with different geographies? Yes. Different economic bases? Probably. Different financial stability? I think that's completely new in the literature. And all of the above. And all of the above is where we're coming into this. And what we want is a measure that captures all these things simultaneously in the proportions that they are important. And it's hard to do that other than some all-encompassing measure. And so thankfully, financial markets will give us some insight into that. So what our ideal measure would do is reflect both the physical and the transition risks, incorporate these climate concerns in proportion to their importance, allow this to vary over time and across cities, so that we can identify cross-sectional differences in how cities are exposed. So the basic premise here is that we're going to, this is not from our paper, this is from a paper by Ingalls, Strobel, and other authors, that basically creates an index of climate news over time. And so the idea of what we're going to do here is we're going to take this index as a measure of how aware are people of climate news and project onto that muni yields, muni returns for individual cities and other controls. And then we're going to strip out what is effectively the beta of that regression to get a sensitivity of city I's muni returns conditional upon innovations in this climate news index. So that's the big picture. So this is the smaller picture, and you can see what we're going to do here. We're going to regress excess returns on this climate news innovation index and other factors that might affect muni returns, strip out those betas for the city-specific bonds, average them, and that's going to give us a city-level measure of climate news sensitivity, or climate risk, if you want to think of it in a shorthand. So, just as an aside, in theory, in principle, you could do this for any city that has traded municipal bonds. We're going to try to err on the side of precision of our estimates by dropping out, for most of our analysis, the teeny tiny cities that you've never heard of, and get rid of bonds that don't trade frequently enough to reliably have return series. And so we're going to have fewer cities measured with more precision, but we also have done it with all the cities that we can, and the results really don't change very much. So, we start with 240 cities. Once we administer these filters, we get down to 104, and I'll show you some of the cities here in just a moment so you can see what we're talking about. By the way, if you're one of those people who is in the weeds along with me, we have all the robustness stuff in figure number 1 and an entire appendix that I'll go through super fast. No, I'm kidding. Okay, so once we get those betas that we have stripped out from those regressions, then we're going to relate those to yield spreads. So take the previous 5-year estimated rolling climate news sensitivity betas, and that's going to go into our regression right here that is obscured by that line in the monitor there. And then regress yield spreads on that to see, hey, are we right? Do we have higher yields where there's more climate news sensitivity? Lots and lots of controls, bond characteristics, different beta estimates from financial markets, and city-level measures of financial health and stability. So we're going to do this Feynman Macbeth style because my co-author is an asset pricer, so I guess we have to do that. And then that leads us to our sort of first baseline result, where we're regressing yield spread on this climate news sensitivity and all the controls. And you can see as we go across that we add more and more things to control for, and we get a coefficient that's positive and significant. And what that means is, if you want to think about the size of the effect, this is on the order of, a 1 standard deviation change in climate news. And by the way, most climate news is bad, in case you didn't know. 1 standard deviation change in climate news is associated with roughly a 1-notch drop in credit rating for these bonds. So it's not tiny. Now, as academics, we all play the game of, yeah, but what about the other thing? Well, there are lots of other things, of course, and so we also run this with issuer fixed effects. So as you are thinking of the other thing I need to do, it needs to be something that is not, that varies through time within a city. The magnitudes here are a little bit smaller, but not much. Okay, so baseline is, yeah, it seems like climate risk is important to these municipal bond yields. Why? What's the mechanism that makes this so? So there are a few things that we can look at. One is how much attention is paid to climate risk. And so one of the tests that we'll do is looking at sort of high intensity times versus lower intensity times. Where are which bonds are more likely to be affected? Those are longer term bonds and worse credit risk bonds. And do they vary with cities' observable characteristics? So in the interest of time, let me sort of go through this, thank you. Let me just sort of go through this validation exercise. And so first validation exercise is confirming what other people have found in the literature, that climate risk seems to matter more for munis recently rather than longer ago. And this is a result that at least 2 other papers have found, and we now confirm that the effects are much larger starting from 2013 on. The effect is larger when the quantity of climate news is higher. The effect is stronger for bonds of longer maturity because this is a long-term risk. And it's stronger for bonds that are of worse credit risk because they're the ones more likely to not pay the coupons as promised. So this credit news sensitivity varies with muni yields in intuitive ways. And so where I view the sort of meat of the paper is the next part, which is, okay, so which cities are these? So let's just go to a map. I love maps. So this is a map of the cities that are in our sample. It's kind of hard to see. Let me sort of drill down on Texas just a little bit, just because that's where I'm from, and we can sort of make some nice little comparisons here. You can see that the darker the shading, the more sensitive these cities are. And so there's a lot of variation even within Texas. So Waco, Texas has very little sensitivity. The coastal towns, Brownsville and Corpus Christi, have a lot of sensitivity. Houston, not so much. Why not? Maybe it's because Houston's an energy town. And it's not coal. A lot of it is solar and wind in Houston. So we did this for a bunch of cities, and so the entire list is in the paper. But as I was going through, the first time I was presenting this around, I noticed something that just really horrified me for a moment, which is look at Seattle and Tacoma. Seattle and Tacoma are basically adjacent to each other. They're in the same state, they're on the same body of water, and yet when you estimate the sensitivity of these two towns, Tacoma is way worse. And so I figured, all right, either we have completely screwed this up, or we're really onto something. So we dug down a little bit into Seattle and Tacoma, and sure enough, Tacoma has more buildings at risk of wildfires. It has a much lower median household income. It has a much higher poverty rate, and the city itself is in much worse condition than Seattle. It's consistent with our measure picking up the things that we want in the ways that we want. Okay, so how does this climate news sensitivity, so now think of this as regressing those climate news sensitivity betas on different city level characteristics. And so if there is higher levels of sea level rise exposure, well, actually, contrary to some of the other literature, we don't find a strong effect there. Part of that problem is there aren't that many cities that are exposed to sea level rise because there aren't that many cities on the sea. But the other measures sort of line up as you'd expect. Standardized climate damages, number of flood instances, and coastal flood instances all sort of line up the way you would think. More physical risk, higher climate news sensitivity betas. Transition risk. So this is one way of measuring transition risk is how dependent is the state's economy on carbon-based energy. And the more it is, the higher the climate news betas for those cities. By the way, this is so heavily correlated with the percentage of adults believing in climate change that we had to orthogonalize it to show you this. But speaking of who believes in climate change, that loads too. So whether you're thinking about this as the percentage of adults reported to believe in climate change, or a slightly weaker version is the percent that voted Democrat in the last election, both of those are related to this city-level climate news sensitivity. And then what I think is my favorite result in the paper is this also relates to the poverty levels in the city. The development literature is rich with the notion of how climate and poverty interact, these sort of poverty traps that climate change causes. And we find significance there as well. The also stuff, I have 20 seconds, so trust me when I say we did it. All right, so to conclude, what I hope this paper provides is a city-specific measure of climate sensitivity measured at the city level that encompasses not only the physical risks, but also the transition risks using the financial markets to get us there. Thank you.
All right, this thing's on. Great. Okay, good afternoon, everyone. Thank you so much to Brookings for putting on such a good conference. And thank you to Alex and his co-author, Sahan, for such great work and for the invite to be a discussant. So I don't have slides because I work in finance and everything has to go through compliance, and so I don't want to do that. So I'm just going to talk about this broadly in this paper. So this is a topic that I'm really interested in, both from my academic background and now in my role as a practicing investor. So my name is Erica Small. I work at Breckenridge Capital Advisors. We are one of the largest separately managed account muni managers in the U.S. So right now we have about $50 billion under management. Over 75% of that is in high-grade municipal bonds. We are exclusively separately managed accounts, so we do nothing with funds. We talked about funds earlier. SMAs are their own unique thing and are certainly sort of the way of the future in the muni market. That's where most of the growth in the market has been recently. But before I was at Breckenridge, I'm just going to give a tiny bit of my background because I do think it helps in my comments or understanding my comments about the paper. So I was an engineer in my previous career, focused on water resources, and then I got interested in how we pay for infrastructure in the U.S., and that led me to the muni market, and I decided to go do a PhD. So I did that in environmental policy and studied a bunch of topics around water infrastructure. And I did write a paper that was actually presented at the Brookings Conference a few years ago, looking at is there a climate risk pricing signal in the muni market? And is there any sort of discernible yield penalty on account of race of the issuing community? So our sample set was a little bit different, but we actually found no price impact from physical climate risk, and we did find evidence of a black tax in the same year that other work was presented by other authors that also found a similar result. And those authors were Ashley Eldemeyer Poindexter and Matthew Winter. So today, most of my comments are not going to be too in the weeds. I guess that's what peer review's for. So my comments are going to be kind of high level, my reactions to this. I'll start with a few comments related to things I think that could be changed slightly in some of the controlling factors associated with this model, and then just high level some of my reactions and maybe one tweak that I think would make the paper better moving forward. So overall, I think this paper was very clear. Did a really good job of walking through exactly what the goals were, and the entire setup made for honestly really easy reading, which was nice coming back into the academic world after not being in it for a while. And I was really interested to see that there was such a clear signal in climate news sensitivity impacting yields. So I guess my first minor comment is associated with the spread calculation. So as I think most people in this room know, spread is the right way to look at a response variable when you're interested in bond pricing, because everything in the muni market trades relative to a benchmark. The authors do a nice job of including the tax-exempt status as one of their variables, and they do actually, we didn't go into this, but they actually show robustness looking at a variety of different spread calculations. So looking at the yield relative to the Treasury curve, the AAA MMD curve, and then also a US dollar swap curve. So they do a nice job with that. One minor tweak is just that in actuality, the way that spreads are calculated is that at least in our world, all tax-exempt bonds are benched to the AAA MMD curve, and then all taxable bonds are benched to the Treasury curve. So that's a really minor tweak, just like a back-end calculation tweak. Right now, the taxable muni market is a really small percentage of the overall market, and I do not anticipate that's going to wildly change the results. The second thing that I wanted to bring up is that, in addition to credit rating, the others, and actually probably even more so than credit rating, the single biggest feature of a bond that drives its spread is the state in which it was issued. Because most of the people that are investing in municipal bonds are doing it for the tax exemption. So in our market, there's 3 states that honestly trade in kind of a league of their own, and that's California, followed by New York and Massachusetts. So the authors do include the issuer or city fixed effects, which in many ways is kind of getting at this with this variability across states. But I think out of a matter of principle, any good research on the municipal market should directly include the state of issue as one of their controlling variables. Actually, like in California, most bonds trade through the scale, so that means that their spreads are coming in negative. And there's been a lot of spread compression over time. So I think that including state directly is kind of the more proper way to do it and would align more with what is actually happening with practitioners. Also, in this particular, for this particular research design, including state directly is interesting because one big thing that we talk about in the muni market is the wide variability in how different states respond to climate events in their local jurisdictions. And to date, we don't have a lot of data on what happens if there's a kind of wide scale series of events that require state aid kind of all at once in the aftermath of a climate disaster. And I can get into that a little bit more in sort of the second half of my more major comments. So including state is my second kind of tweak that I think would, again, not change the overall results given their current design, but is something that I would want to see. And then the final minor comment, so the authors they do look at climate news sensitivity, but they also do directly incorporate, as you saw at the end there, direct measures of physical climate risk, including sea level rise and flooding, but they don't include direct physical climate risk measures for some of the other hazards that the investment community thinks about. So they don't have a direct measure for wildfire, drought, or heat. I know data availability is somewhat of an issue, and a lot of the data that we use is proprietary, which is not available to researchers necessarily. But I think that would just add a little bit to the paper. Okay, so my major comments. The first one is that I was honestly quite surprised to see such a robust result where climate news sensitivity was positively associated with yield spread. So the authors, in short, found that areas that have higher climate risk exposure are paying more for their bonds after controlling for all other factors. As a practitioner, this is something that if you ask any traders that work at my shop and a lot of their counterparts, most would say that they do not see a pricing effect of climate risk. Most of the muni market participants right now in 2024 are still focused on physical climate risk. And so when they say things like climate risk is not being priced, they're not really talking about transition risk whatsoever. At least they don't think they are. So the authors do include transition risk, and that might be a reason why they showed a pricing signal. A lot of people in the municipal market are talking about the fact that there's just been this large issue with a supply-demand imbalance over time, where the muni market has been roughly $4 trillion US for the past decade plus. At the same time, wealth has increased. At the same time, Treasury issuance has increased exponentially, and you're seeing that in the ratio tightening. But I also think that that's driving a lot of what we as practitioners see, which is that there's just so much demand for bonds and just not enough supply. So even when bonds are being issued from higher climate risk areas, that sort of effect is being drowned out because people just need to buy the bonds anyway to meet demand. I do think that this brings up an interesting thing of note, which is that the authors are looking at climate risk in one way, which is very different from the way we practitioners look at climate risk. And I think this comes down to when you're creating these study designs, your measure of climate risk matters a lot in your overall results, even if you're controlling for all the other factors in kind of the same way. So on my last bit of time here, the last thing that I would want to consider or have the authors consider is the influence specifically of race on driving up their spreads in these service areas, which they're focusing just on cities. So there's now been more than a few studies, I was one of them, but I'm not the only one, that showed that communities that have a higher percentage of Black residents pay more for their bonds even after controlling for a lot of the socioeconomic variables that these authors do. So I do wonder to what extent any sort of pricing signal that they're seeing, that they're attributing to climate has to do with race. And we know in the United States that there tends to be a high overlap with certain physical climate risks, not all, and a higher percentage of non-white residents. So I just think that adding that would really improve the overall results and kind of the overall robustness of those findings. So that concludes my comments. Thank you all, and congrats again to the authors on great work.
Okay, thank you. Thank you, Erica and Alex. I see a bunch of hands up, so let's start with Leah.
Hi, I just wanted to follow up on why you thought local attitudes about climate change impacted the pricing. Like, what's the mechanism there?
So the idea is if retail level investors are the marginal price setting investor, which they might be in muni markets, then how they view climate news might matter to the pricing.
Local retail investors?
In the state, yes. That was the thought.
Yeah, thank you very much for this excellent presentation. Just a simple question. What will be the effect of having in place risks management, risk transfer measures on the spread? Yeah, thank you.
He just took away your microphone, so I can't ask you a follow-up question. What risk transfer measures do you have in mind?
Yeah, for example, insurance.
Yeah. So, if you view climate as creating the potential for default risk, then it seems like any risk management measures should mitigate that. That's my view.
Hi, Alex.
Hey, Sergey.
Very interesting and creative paper. What I'm trying to wrap my head around still is like you have this measure and it's measuring the way that from what I can see, like risk from the perspective of creditors. But that seems different and not necessarily the same as risk from the perspective of the city, right? And your results on credit ratings actually point to that, I think, right? That you could have a city that's AAA rated, doesn't have much debt right now, exposed a lot to climate risk, right? But because it doesn't have much debt, there is not that much risk to creditors, and you would be measuring it as a relatively low value, even though there is a lot of risk to the people living there, to the taxpayers, and to the city. So I'm trying to think of how you can push this forward to actually kind of calculate the overall measure, really from the perspective of like taxpayers and residents of the city, not limiting it to bondholders.
Yeah, so I guess you can take a sort of narrower view of what we are actually measuring, which is maybe this is capturing the ability, and maybe this goes to the previous question too, maybe this goes to the ability of the city to absorb climate-related risks. And some cities are going to be better at that than others. And so we have some results that sort of partition this based on how solvent does the city look. And so like the little case study of Seattle versus Tacoma sort of speaks to that. Tacoma has very weak financials and Seattle pretty strong. And we see that feeds through to our measurement of their climate risk or climate sensitivity.
I was wondering if there's a control, like if times when climate news is high, if that's also correlated with other just like reporting in general, and whether there's some sort of news that you think wouldn't affect munis at all that you could put in like step one and then recover that beta as well, and then see if that's sensitive either.
Yeah, so it's a good point that maybe this is just news in general, not climate news. So I guess if I were going to go down that road, I'd probably want to use the non-climate news basically as a placebo. But it's a good idea.
How when I was looking at the Seattle-Tacoma comparison, which is a really striking comparison, I had two thoughts. The first is, how stable do these relative coefficients within states tend to be over time? And thinking about Corpus Christi being highly exposed, Waco being less highly exposed in the overall coefficients, is that something that tends to be stable if you sort of partition it by, across different parts of the sample? Is that?
It's hard to answer that because, in part because of our empirical approach, right? So these are based on 5-year rolling averages. And so it's going to look stable even if it's not. And so we need to think about how to try to allow for that instability to show up in our data. We haven't done that yet.
And the other, this relates actually to work that we've seen previously today, also work that we've seen at this conference over the years about situations where you have states whose governments are kind of at war with their own cities. I mean, you get like a Republican state leadership. Sometimes the governor sort of will go to war with the cities.
I'm from Houston, I know.
Is there a way of sort of trying to identify the extent to which local losses will be, the state will or won't come to the aid of a municipality in trouble?
Good question. I guess if I were going to try to go down that road, I would look at something along the lines of the percent of the population of the city that is Democrat versus Republican compared to who's in the governor's office. That might be one way to approach that.
I see Anna.
Thank you. Interesting paper. So it was kind of along those lines of what Dan is asking. Has anybody tried to estimate the potential losses that a municipality will suffer as a result of a climate event, such as, let's say, a forest fire, probably not as much, versus flooding? And, like what infrastructure will suffer, what infrastructure will be affected, and so on. I don't know, not in your paper, maybe you have some, if it's in line with your estimates on the bond yields.
Yeah, we have so many infrastructure people in the room, they can probably answer that better than I. The space of the literature that I know better is the folks who, kind of like us, are regressing muni yields or yield spreads measured in various ways on stuff. And that stuff might be sea level rise, or it might be wildfire exposure, it might be whatever. But I haven't seen the estimate of the actual dollars of infrastructure damage. It's a good idea.
Is this on? In the investment world, that's actually the exact data that we pay for. So, was there another question? What did you say?
No, you pay a lot.
Yeah, we do. Yeah, data is expensive, but a lot of the data providers are actually pretty interested in pairing with academics. So if you're interested in knowing where our data is from, I'm happy to provide that information with you. You could talk to me, and it's out in the open who we use. So, and I know the data providers there. They actually are pretty open to talking with academics. So.
Okay. So, do you observe any people moving out that area, or firms relocated, or housing price going down? All this kind of
It's a good question. Good question, Lei. There's another paper that looks at house prices, and they find that yes, house prices are lower in the climate-exposed cities. I haven't seen the, migration in the literature. I can tell you that when my wife and I talk about where we're going to retire, it's probably not Houston, in no small part because of the climate there.
Galveston.
Yes. Waco.
Okay, I hope you'll join me in thanking Alex and Erica for fantastic.
Yeah, thanks very much. So we're going to take a break for about 10, 12 minutes. Why don't we come back here at 4:40? Can we get everybody to sit down for the last act of the day before we start drinking? Oh, I like the binder.
Thank you.
Just don't leave it on the train. Let me get the
Okay. All right, is it on? It's on. Welcome, everybody. Thank you for coming back in. I know it's been a super long day, but I hope you found it a really interesting day. I have found it interesting, and I think this will be a really nice end of the day discussion. I'm Louise Shaner. I'm here at Brookings at the Hutchins Center, and I do a lot of work on state and local government and state and local finances. So today we are going to be talking about what is going on with infrastructure with this massive increase in funding that we've seen both through we've got the IIJA, which is the Infrastructure Investment and Jobs Act, also known as the Bipartisan Infrastructure Law, that was passed in November 2021, and then the Inflation Reduction Act, which was passed on a party line vote in 2022. So together, the legislation has provided over $1 trillion in new funding for a wide array of projects, ranging from standard transportation to clean water to broadband to climate resilience. A lot of it is accomplished through a combination of formula-driven and competitive grants to state and local government. So that's where the state and local government comes in. We have an amazing group of experts for this discussion, and you all have their bios. They're very amazing bios, and if we would read through them all, it would take half this session, so I'm not going to do that, but let me just introduce them really briefly. Samantha Silverberg, or Sam, is the Deputy Assistant to the President for Infrastructure Implementation. And so she is working hard on thinking about how is it going, how are we using this massive increase of funding. Jeremy Eby is the CEO and founder of the Phoenix Infrastructure Group, working with public and private investors and governments to drive innovation and infrastructure investment. Got that from the website. Zhang Li is the Deputy Director and Chief Policy Officer at the American Association of Highway Transportation Officials, so he works with highway officials across the states. And Aline Buckberg is a Senior Fellow of the Salata Institute for Climate and Sustainability at Harvard University. So we're going to make this hopefully just a conversation. I hope you guys interrupt each other. We'll have a talk, but I will guide it a little bit. So let me just start with you, Sam. So you are responsible for implementing this massive investments in infrastructure. How do you see the progress achieved so far from this legislation? Has it got off the ground as fast as you had expected, as you would hope? And what are some of the impediments that you've kind of faced?
So first, thanks, Louise and the Brookings team for having me here today. Before I dive in for infrastructure, I'd love to just take a bit of a step back and kind of put it all in context. So when President Biden took office in January of 2021, everyone remembers we were facing a once-in-a-generation pandemic, stifled supply chains, crumbling infrastructure, an economy nearly at a standstill, and that was on top of many deep structural challenges like growing income inequality, the racial wealth gaps, and the climate crisis. And so in the midst of those challenges, President Biden mobilized Congress to pass this historic legislation to grow the economy, boost our competitiveness, build a clean energy future. We call all of that the Investing in America agenda. And so that's the American Rescue Plan, the Bipartisan Infrastructure Law, the Inflation Reduction Act, and the CHIPS and Science Act. And through those laws, the president is really delivering on his commitment to grow the economy from the middle out and the bottom up, not the top down. And so, first, within weeks after entering office, the president worked with Congress to pass the American Rescue Plan, which supported an immediate, strong, and equitable recovery. Then about a year after he took office in November of 2021, Congress passed the bipartisan infrastructure law, representing these real historic investments in the foundational infrastructure needed for our economy to thrive. The following year, after a lot of negotiation, IRA and the CHIPS and Science Act were both enacted, really designed to grow the economy's productive potential in critical sectors. And again, all four of those bills are united by a theory of the case around enabling smart public investment in targeted areas to fill gaps, boost productivity, and spur additional private investment. And so you asked, how are we doing? We are delivering. Obviously, there's the kind of the big macro stats that this group and Brookings audience know very well. We've created over 12 million jobs. Over 800,000 of those are manufacturing jobs. Another 800,000 or so of those are construction jobs. Unemployment rate is at record low. GDP is growing. And we've seen strong wage growth for all employees, which is really important for President Biden, who cares first and foremost about the American workers. Another measure of success is what things are looking like on the ground. So to date, we have announced over 60,000 specific infrastructure and clean energy projects all around the country. That's on the public side. Again, part of the theory here is that we are making smart public investments to then spur private capital. And so companies have also announced almost $900 billion of complementary investments in industries of the future, like semiconductors, electric vehicles, clean energy, and that's all catalyzed by the administration's progress. And so, on the bill side, the bipartisan infrastructure law, which is what I focus on, we are in the middle of a 5-year bill. So Congress provided this bill with 5 years of funding. So we are into kind of year 3 of that. Over 60,000 projects, which includes mega projects, things like the Brent Spence Bridge between Kentucky and Ohio, the Hudson River Tunnel, Bright Line West, which is the new high-speed rail line between Vegas and LA, Sulaks in Michigan, which is an important Army Corps project for our supply chain, but also thousands of what we think about as backyard projects. So those are things like laying fiber for high-speed internet, or replacing lead pipes, or improving road safety. And so, these are moving. To your question about kind of pace of implementation, we have really hit the ground running. I'll say here, and I think this will be a theme for us, this is not intended to be ERA, right? This is not the 2009 Recovery Act. And in the words of Secretary Buttigieg, we are funding a mix of shovel-ready and shovel-worthy projects. So there are some things that are moving really fast, and then there are some things that are visionary and transformational, and in order to achieve the impact, they are taking time. We are doing a number of things to make sure that any impediments that we do have to implementation are being knocked down early. I don't want to take up too much time here, but those are things like manufacturing. Do we have the goods that we need? Workforce. Do we have the people that we need? Permitting is the kind of bureaucracy moving as quickly as we can, and then also a real focus on capacity. Do the state and local governments who are receiving this money have the resources, the skills, the expertise that they need in order to both win funding and then deliver really great projects? So I'll just tease some of those things because I'm sure we'll come back to them. Thanks.
John, why don't we start? Oh, sorry. Oh, thank you. Thank you. So, John, you represent state departments of transportation. So, when you look at this legislation, has this been a game changer for them? And if so, in what way?
It's definitely a key part of how they deliver their transportation infrastructure. So the federal investment typically represents about 25% of total capital and O&M expenditures for transportation infrastructure. But what IIJA did is re-up for another 5-year cycle on a multi-year funding commitment basis, which is really important to be able to provide a stable, predictable funding beyond kind of the 1-year cycle, typically, as part of the appropriations process. And, the impact does vary in terms of, if you look at the highway side, it starts from a very big base, right, out of the Highway Trust Fund. So it saw about a 20% year-over-year increase in the first year of IIJA from the prior FAST Act legislation. But you look at rail infrastructure, and that saw almost 500%, right, because that started from a much smaller base. So it does vary, I think, in terms of the mode of transportation, but it is absolutely fundamental to how state DOTs, provide their transportation infrastructure to have this predictable federal support. In terms of, I think, the challenges that we're seeing, part of it, has been the expectation management, right? Because historic amounts of funding, which is true, but then, for state DOTs that are the single, really collectively the largest recipient of federal transportation dollars, it's not all new money, right? It's a lot of existing money kind of plussed up there. And then when you look at kind of the inflation impact that subsequently, played a bigger role than going into the legislation, and then the workforce shortages, the bang for the buck has been, I think, an important kind of consideration here. And that makes it even more important that what we do it efficiently. There are also, I think, something that we work very closely with Samantha and US DOT, right? In terms of policy trade-offs involved, I think a classic example is the EV infrastructure where, we want to support, and we do support the president's goal, right? 500,000 chargers in the ground. But when you also look at Buy America requirements, and when you look at that, it's a nascent industry and there aren't as much domestic capability here, you just can't do both at the same time. And we want to try to do as much as possible, but I think that's the kind of the initial growth that we are starting to kind of get over the hump there. And then I think in terms of, there's been questions about this notion of maintenance of effort, which was a kind of a big policy question back in the era days of if federal government throws a lot of grant money here, is that going to displace state and local funding? And on that, I would say that, the federal government hasn't raised its gas tax rates since 1993. And in the meantime, pretty much most of the states have adjusted their tax rates that support their own transportation funding. And that has, I think, more than enough kind of supplemented or complemented that the federal dollars coming our members' way.
Wait, so the federal government hasn't raised their gas tax, but now we're getting a whole bunch of money. And so what does that imply about whether or not the states will finally say, okay, finally the federal government's paying up and we can reduce our spending? So do you think on the crowd out?
No,
Yeah.
so there is kind of the federal programs typically in transportation come with like 80-20 cost share arrangement where 80% of it, and a lot of it is really focused on the capital side because the O&M stuff is all the infrastructure owners and operators at the state level that have to figure it out, in perpetuity there. And a lot of that federal funding increase wasn't the gas tax doing it. It's just a lot of general fund transfers directly into the Highway Trust Fund, about $110 billion on top of another $160 billion since 2008 because of Congress's, I think, kind of the refusal to slow down program funding because they see the value of it, but they don't have the political willpower to raise the gas taxes. And then there was also a special form of this kind of advanced general fund appropriations that they did where they kind of like tied their hands behind their back saying, here's our general fund dollars, but we can't touch it for the next 5 years. That's what we're telling ourselves. So those dollars are as stable as you can see, but it is kind of seen as emergency funding treatment that we'd love to see it in the next bill because we're already thinking about it. But to be able to continue that level of strong general fund support on top of highway trust fund funding, that is a huge question mark for all of us.
Okay, we're going to come back to some of these topics. I'm going to let everybody kind of have their first spiel, and we're going to come back a little bit. And this question about, to what extent will we be seeing new investment versus existing, I think is one we want to come back to, and we're going to talk about electric vehicles, too. But let me move to you, Jeremy. So you are in the public-private partnership space. So can you just tell us a little bit about one? So we heard a little bit before about the use of consultants and state DOT capacity in a different paper that before sort of raising costs. How do you think about the sort of optimal mix of private and public, and why is it important to have a private component?
It's a great point, and see if I can bring this mic back. Can you hear me okay? Okay. Again, great to be here. A little bit about Phoenix and about the space where I'm coming from. I think that you're kind of seeing a different participants here, and I guess maybe I'm a little bit the one that doesn't fit in, probably the least educated out of everyone here, but also coming from the private sector. We have a different role to play, but as you noted, is a partnership. So, when we talk about funding, when we talk about these, all the grant funding, all the different dynamics here, at the end of the day, We're talking about assets, we're talking about infrastructure, even no matter where you're coming from, either from the municipal finance space, from federal funding, from state funding, we're talking about actual assets. How do they get built? How do they get delivered efficiently? How do they get delivered to the highest technological capability? And how do they ultimately support a national economy? And that's the whole goal of everything that we're doing here. And if you notice, when you look at infrastructure spending at a federal and state level compared to GDP, many times as that goes up, GDP will follow. So there's a lot of efficiency here that can be created. The root of it, and I did go to school. I went to the Harris School. I went to the Booth School of Business at U of C. But one thing I learned is that the one religion, I guess you could say almost, that I got out of it was that when you bring in the private sector to participate with the government in delivering actual assets, you have the ability to really tap into a lot of enhancements, and at the same time you can transfer a lot of risk. So a few of the enhancements that I'm talking about, we kind of noted technology, which we're going to go into a lot more. We've noted basically efficiency of financing, efficiency of really delivery, on time, under budget assets delivered. And we're talking about also scale. When you talk about the $1.3 trillion, wherever it is right now, based on the value of inflation, based on the inflation, if that's decreased at all, when you think about adding potentially additional financing from debt markets, you can possibly triple that to maybe $3 trillion if you're looking at fully private, funded, financed assets. So ultimately, let me get back to the market, onto the ground. All these projects are delivered by construction companies, engineering companies, combined with investors and developers, design teams. Phoenix and a lot of us that are part of this kind of leading the private sector are investor developers. We source capital from pension funds, insurance companies, private wealth, sovereign wealth, variety of different kinds of capital. They're looking for long-term returns that are essentially less risky than you'd say equities. Okay, so they want almost like a debt type of yield, a debt type of risk with an equity even higher than equity type of yield. We're talking about mid-teens.
Don't we all?
It sounds pretty good. It sounds pretty good, but I will tell you, it sounds too good to be true. But we invest with me then. No. And so what is evolved here is that, and you'll look here, and I'll limit some projects here in this region that we're involved in that are really impactful, that are those exact kind of projects. We're an investor developer in the DC street light system. When you go out tonight, check out your lights. They're brand new. We just completed installation of 75,000 lights. We did that through a public-private partnership. We design, build, finance, operate, maintain, transition those lights from gas-powered to LED lights. And we received from the government, from the DC government, a payment, availability payment for making that asset available to the public, okay? If we're off at all, and it's a contractual marriage relationship. If we don't deliver in certain dynamics of the project, for example, if a light goes out and it's just sitting there for a whole day, we get dinged. We see 75,000 lights on a remote monitoring system, and we basically are able to go across the city and identify where the issues are here, okay? We are under contract with the government to execute. They pay us to do that. They pay a fee. They pay ultimately an availability payment that, and ultimately, for our investors who are, as noted, insurance companies for the most part, anyone with long-term liabilities, you can imagine, this is a 15-year term, anyone with that kind of a term, they want that kind of an asset, that kind of a return, okay? So you have all of these interests that are combined, private capital, private markets, combined with efficiencies, combined with the goals of the federal government and the state and local governments. And I'll make a note to Samantha, to say, Sam, I can say in my industry, we were waiting for an infrastructure bill, an IIJA type bill through end of Bush. He did come forward with the TIFIA, if anyone knows about TIFIA. We waited through Obama. We waited through Trump. And we did get one in this administration. I think, as we just kind of, one note I want to leave with is I think that it's incredible. I think it's a great project. It's a great bill. It's a great push for the country. The question will be, how do we get this money out? And the goals that initially were presented and have been presented at the beginning of this bill, and actually I've seen it presented throughout its delivery up to this point, how will the states and the local governments who have received this funding and can access this funding, how will they get to procurements to bring us forward, the private sector, to bring your partners in to meet those goals, okay? And how can they scale quickly? How can they scale and meet those goals? I'll say one note, last note. I'm seeing changes when you have conversations with state DOTs, when you have conversations with counties and cities and mayors, they have a bigger view of what they can do because of the activity from the feds. So let's see where it goes.
So I'm going to ask you, Elaine, first about this question that sort of has come up a little. I mentioned it before. So I do a lot of state and local, and one of the big questions I have just in general, and if you were at the lunch, I started with this, which is that states got a ton of money during the pandemic, not transportation money. They got a ton of money during the pandemic, and it's not 100% clear that they really used much of it or most of it. They will fill their forms in with the Treasury that says, I took the money and I spent it on this. But a lot of times it looks like they just sort of reduced their own funding, and now their balances are really, really high. They've got all this savings. So this bill was obviously intended not to just save states money, but to actually, improve the infrastructure of our economy. How do you see that as going? What considerations were put in to try to make sure that's happening? How will we evaluate that? Oh.
Great question. So I see IIJA as a true boost to investment, to infrastructure investment by state and local governments and overall. And so first of all, for those programs that flow through the states with a predetermined, for almost all of them flows through the state, and certainly those where there's a predetermined amount per state, the state and local governments need to co-invest with the federal government. So you can think of it like a copay under your health insurance. Moreover, it's not as if they put in a list and say, here are the projects we're going to do. They add up to the right total times, 80% of those add up the right total, give me the money. Actually, it's a little like if you were renovating your kitchen and you hired a contractor, and you'd have an agreement where at this stage you pay them. And by the same token, the federal government makes the payments to those state and local governments as they progress along the way. So federal highway funds, including those under IIJA, have a requirement that the state is providing 20% of the total, or 25% match the federal funds. And so that ensures that the state and local authority, or whatever combination, they have skin in the game and that they like the project enough to be putting up their own dollars. And that also implies that they think they like it enough that they plan to pay to maintain it in the future. And so there are, everything that's allocated by formula, just about with very few narrow exceptions to lower income communities, has a copay, as do many of the programs that go to state and local governments but require an application. And so you also asked about, so what happens to basically state and local budget constraints? How does that vary? So before IIJA, state and local governments were basically paying way more than their minimum shares. So it's not as if they had to pay 20% of a highway project and they were only paying 20%. Across highway capital investment projects, they were paying about 45%. Across transportation and water, they were paying about 60% of the total.
You mean that they sort of did everything they could with their 20%, and then they're like, that's not enough money, and so then I'm going to do some more stuff without federal funding.
So if you give them more federal dollars, so what happens to the total amount of investment? Well, if they hold their budget, state and local governments hold their investment budget fixed, but you put in more federal dollars, you get to do more. And in terms of what's the longer term cost implications, and do you need to maintain a bunch more stuff?
Yeah.
Well, it depends a little bit what you're doing. Most highway funding, for example, is not building out new highways at this point. It's major rehabilitation that qualifies as a capital expenditure. So to the extent that you're talking about highway projects or airports or very water systems that tend to be very aged, if you're going to raise the overall status and replace really aged infrastructure with new infrastructure, then your maintenance costs could actually go down even over a larger set because you're just dealing with newer assets. And so bottom line, I think it's a real boost for investment because state and local governments need to pay along with the federal government, and they need to like the asset enough to be willing to do so and to maintain it.
Denise, can I respond
Yes.
to this too?
Yeah.
I just want to respond on this point also, which is that I think if states and communities would have invested in these projects but for the feds, then the answer is that this is not a net increase, right? But I think we have a lot of evidence, namely the tremendous infrastructure backlog we have in this country, that they weren't going to do this on their own. So, we are making progress on projects that would never have proceeded under business as usual scenario. Anything that relied on typical funding or financing. Some of this is because we have targeted projects that have such a high capital outlay requirement that states or communities on their own would not have been able to raise the capital to do it, right? So the Secretary Buttigieg today is announcing $5 billion for 13 bridges around the country, including the interstate bridge replacement, I-5 between Washington and Oregon, which is going to be a $4, $5, $6 billion project, Sagamore and Cape Cod, a bridge in Harrisburg, a bridge in Wilmington, all over these huge, huge projects that have been waiting for literally decades. And then there's also a lot of smaller projects that have sat on the sidelines for years and years and years because communities just didn't have the money to do them. And that could be anything from, again, lead pipe replacement. We have 9 million lead pipes in this country. That's a travesty. To sanitation in Indian country, where we still have folks living without adequate wastewater systems, to cleaning up brownfields and Superfund sites. So I think there's just a lot of evidence that these are net new investments that wouldn't have happened otherwise. And then you have the areas and the critical sectors where federal investment unlocks private capital. So again, I think I can't quite prove the counterfactual, but my strong sense is that the evidence points to the fact that this is net new investment. The other thing I'll say is that if our subsidies for state and local governments for things like transportation and broadband and water and resilience and clean energy are freeing up revenue to invest in things like housing, then I'm okay with that. Right? Because I think there's still net positive impact there. And so I just wanted to be able to make that point.
Yes.
Yeah, if I can just share I completely agreement with Samantha in terms of, especially the big bridge projects we noted are such great examples, in addition to the Brent Spence Bridge in Ohio, Kentucky, Blatnick Bridge, Minnesota, Wisconsin, all these bridges that's been talked about for decades, as she said, it's finally getting done because these assets are so big and complicated and so expensive, capital lumpy, that states can't squirrel away their formula dollars, as big as they may be in billions of dollars, for many years and be able to just do one project. And that's where I think one of the things that we're trying to balance here is the formula dollars that Elaine talked about that are kind of plug and play, the bread and butter, whatever analogy you want to use. That's the base of the program for a long time. The competitive grants is where I think there is a real opportunity, and you look at public-private partnerships to do the really big and complicated and expensive things. I think the challenge that we're seeing is that there are so many new competitive grant programs of different scales that when you're talking about a $200,000 planning grant award, that's where we then start to question, is the level of federal oversight and involvement for that kind of amount really the best use of the productive capacity and scale of the federal government?
Yeah, I'd add. Jung was speaking a bit to leveraging the private sector. I'd add that there's been a pretty solid push from IIJA and generally from Build America Bureau, for example, on really getting states and localities smarter about engaging with the private sector. I think that has been one major issue over the years, over the decades. When I think about it, why I got in my business was I just knew that most of the roads have been built in the 1950s. They're post-war roads. Many schools are from the 1960s and 70s. Many water systems, who knows where they're from? They're all really aged assets that are at end of life. And the one point I think that was also is the other issue I saw, and Elaine talked this, is O&M, operations and maintenance, is critical to any asset. If you have a house, if you have any asset, if you don't take care of it, it falls apart, people get hurt. And traditionally, state and local governments, they do not directly identify I like to say this to cities and counties especially, identify O&M really directly until it becomes an emergency situation. Then you get your federal funding for your water system in Jackson, or for your levee and dam system in New Orleans, or for your, you name it. Your Flint water system, O&M is everything. So to me, it doesn't, it's another, so you're looking at new assets, you're looking at poorly maintained assets, and then you're looking at maybe not the most efficient assets. So if you don't have the most efficient assets, if you're creating more efficient assets as technology goes forward, as society moves forward, you're matching and you're progressing with it. If you don't, obviously you're your macroeconomy is going to struggle. So I think, and I'm not tooting the private sector. I think that the private sector has to operate. It has to operate on these levels. If you're not evolving, if you're not catching up with the pace or leading the pace, you die. And I think that level of engagement, we're seeing that more. I think there's got to be a lot more going forward. I think what is great about, especially when you're talking, from my perspective, maybe my social perspective, having some sort of idea that, well, here's some goals we'd like to provide for communities. We'd like to have housing be a dynamic within whatever we do. You see that within, I don't know as much at the federal level, you see that a lot on state and local levels for projects, particularly. Energy, sustainability, really big points. One point that I wanted to add that Samantha noted, she was talking about different prerogatives that were direct. One that I noted was the Justice 40 within IIJA, which is really designed towards hitting kind of these inequities, these historical inequities. I'm from Chicago. They built 94 right through several African-American neighborhoods. The federal government paid for it. Destroy these neighborhoods. And that's across the country. There's been Justice 40 tries to handle those issues, turn them into green spaces, make them more, build more communities where they were destroyed. Those kind of initiatives are really positive. That I think, when you talk about someone like me who's just looking for a return and yield and risk, okay, I'm good with having a project that also provides these really strong social positives. So we're in a good position. I think that we just need to continue to enhance it, continue to move forward on that, and on all those fronts. But it's a great start.
So that was sort of one of the questions that we wanted to get to, which is, you sort of need capacity for these competitive grants to figure out how to get the money, how to procure it, how to get the contracts. And as I said, we talked about that earlier today, whether or not there's enough capacity and whether or not the places that need the money the most are capable of actually, like, who's going to be the first, who's going to make best use of the money, and are we going to get the outcome that we want? And whether or not you see that as an issue. Anybody?
It's an issue.
Yeah.
I mean, I could say that, we had equity in mind from the moment we were designing these programs, and we see that being achieved in a few different ways. I think one is, to Jeremy's point, we have a set of programs that are at their core about rectifying past inequities and supporting disadvantaged communities. So the Reconnecting Communities program that you mentioned, which is spending $4 billion all across the country, it's IRA and it's bill funding to cap highways, to create these green spaces, to tear down highways, to create viaducts. I mean, they're happening all over the country. The president was in Milwaukee to make this announcement earlier this year. That's like a program that at its core is about equity. Then as we implement programs, we are building in equity, and that means that as we're evaluating applications for competitive programs, ensuring that Justice 40 commitments are met, 40% of the benefits of infrastructure and clean energy projects are going to disadvantaged communities, which are those that have either income inequality or have been overburdened by pollution. This is an environmental justice push. But then, and I think what you're really getting at, Louise, is around, how do we make sure the communities that need investment the most are able to access and then deliver, right? Because it's not enough to win a grant. You have to actually deliver a really great project, and that is hard. And so over 90% of infrastructure law funding will be deployed by state, local, tribal, territorial governments. And so we are focused on making sure that all of those folks have a good understanding of the opportunities that are in front of them, how to access them, and then how to deliver them. So we have worked with all of our federal partners on technical assistance. There are programs at every agency. I'll give you a few of the highlights. DOT has one called the Thriving Communities Program, which pairs under-resourced communities with capacity builders that are funded. Some of those are private consulting firms. Some of those are nonprofits and others. And we've seen a real benefit there. So communities, before and after their engagement with this program, have increased the probability of success by 50%. And so we're seeing those be much more successful in accessing funding. EPA and DOE have environmental justice, thriving communities, technical assistance centers, TICTACs, that are working.
Catchy.
Nice, right?
Catchy.
Good, catchy. So they're working, with these EJ communities, helping them write strong grant applications, navigate federal resources. EPA also has over $500 million dedicated to supporting disadvantaged communities access water projects, including lead projects and others. And then FEMA also has a great program where they're partnering directly with communities to help them secure funding for projects for resilience and storm mitigation and things like that. We've seen, again, real results. A community that was really close to the heart of my former boss, Mitch Landrieu, was Lowndes County, Alabama, in the Black Belt that had really inadequate wastewater systems, and by technical assistance and support that they received through FEMA and the Army Corps and others, they were able to get the money they need to really improve those systems. And then we've built a variety of tools, including a guidebook of all 375 programs in the infrastructure law. We have a complementary guidebook for all the programs in the Inflation Reduction Act. We have tools on invest.gov where we show where the investment is on every single state. You can zoom in, see your community. We have a fully downloadable spreadsheet of all of that. And so, some of it is about making information accessible. A lot of it is about demystifying. And then the third piece I'll say is about, streamlining federal rules, right? Like, how do we make it easier? Because the bureaucracy is, notorious. A lot of that is because of how Congress has written laws, but there's lots that we could do. So that could be everything from combining multiple opportunities into one. So DOT has done this where there are 3 different programs named Infra, Mega, and Rural. Those, if you are a community that wants to build a really big piece of infrastructure, you now apply once and you just check a box if you want to be considered for all 3 of those. And that, that's reduced a lot of burden. HHS has also done a pilot where they're simplifying NOFOs down to just a...
NOFO?
What's that?
NOFO?
Oh, thank you. I'm sorry. Notices of funding opportunity. Catch myself. Anyway, point being, equity is at the core.
Yeah.
We have programs that are designed specifically for it. We're building in its implementation, and then we're really focused on technical assistance because we want to make sure those communities can access the great opportunity that we have here.
Okay, let's shift gears a little. So one thing we haven't talked a lot about is, we mentioned it once, EVs. So that's just like an interesting part of this legislation, and maybe another thing that we're going to see really big difference in terms of climate and the ability of electric vehicles. So Elaine, you've been studying EVs. I'm going to just open it up for you.
Great question. Favorite topic. So both IRA and IIJA support both rolling out EV infrastructure, and since we're talking about state and local governments, it also supports state and local government investment in their fleets of different kinds. So I'll touch on that too. But IIJA provides $7.5 billion to fund EV charging. Of that, the overwhelming majority is designed for highways. There's $5 billion for major interstates that are going to the states via formulas. There's another $1.25 billion that's also designated for highways, but that's discretionary. And then there's $1.25 billion that's reserved for charging in communities, and 40% of that does go to your EJ disadvantaged communities, and that's allocated discretionary. So why the focus on highways and on disadvantaged communities? So every potential EV buyer wants to know they can do a road trip in their EV. So rolling out that highway charging to give people the confidence that it can be an all-around vehicle is really mission critical for adoption, and that's a huge amount of what I work on at Harvard, as well as my colleague Cassie Cole, who is in the audience. And that's important even for those who charge at home. But in disadvantaged communities, installing home charging is probably more difficult, because a lower income household, even if they can buy an EV, and maybe they're buying a used EV, and they'd appreciate the savings versus gas, but the odds that they can install home charging are lower because they're more likely to be a renter, to live in multifamily housing, and so on. So public charging infrastructure becomes all the more critical so that EVs can be an option, and they can access both those environmental benefits in their neighborhood and the savings versus having a gas car. So IRA also lowers the cost of installing private charging. Businesses get up about 6% of the cost, up to 30% if it meets all the right wage and apprenticeship criteria. Households can get a credit up to 30% of their expense, up to $1,000. Now here's the not so great news though. Spending on IIJ chargers has been slow so far. So 2 years in, we've got 7 states with 9 charging stations. The winners are Hawaii, Maine, New York, Ohio, Pennsylvania, Vermont, and Utah. They're more under construction in those states. But there's a lot of work to do. I want to touch on also how
Can you tell us a little bit why you think it's been so slow?
So one, I think that you have to, find your sites, and there was some planning aspects. But two, when you're installing a fast charging station, you need a lot of power. And the requirements for these IIJA NEVI chargers is that you need to have at least 4 stations, four plugs, like gasoline nozzles, all of which that can simultaneously deliver at least 150 kilowatts per hour. And that often requires, often the power is not already there. That requires a transformer, that requires planning with the utility. Transformers may be on back order. So I think that's some of it, but I think also it's a new area of investment for these governments in many cases. There's probably learning and delays. So I wouldn't be surprised if we get a little bit of snowballing coming soon, and Sam will probably jump in and address that in a second. But I just do want to touch on the fleet investment.
Yeah.
So first of all, the commercial EV tax credit up to $7,500 for a vehicle up to 14,000 pounds. That's basically anything you'd think about as an ordinary vehicle, and up to 40,000 on big vehicles. State and local governments can actually access that by going through the dealers. Happy to expand on that. And there's also special funding in IIJA for replacing $5 billion for replacing school buses, $5 billion for transit buses, and $2.5 billion for ferries. So there's opportunities to convert those government fleets as well.
It's safe to say, though, that when I think about it from the infrastructure space, the challenges that what can I say? When I look at fleets, I think that's a very attractive opportunity. If I could provide buses and I could provide charging stations to counties and to cities that are running their schools or whomever else, I would jump all over that as long as I knew I was getting a guaranteed payment. If I could build a train station, and we have a train station in Charlotte, knowing that, or a bus depot, knowing that I was going to get subsidy to put in chargers. We're going to have to put them in anyway, but if I knew I was getting subsidy to put in those chargers for those buses, those interstate buses, and I knew I was getting for parking as well, I'm doing it. Now, you throw me out there off of a highway, and I'm going to put a charging station. I think that business, that's a harder business for me to understand.
Right. Well, that's where that's the externality where it's promoting EV adoption, but that's a role for government to come in. With regard to fleets, all fleets, private and public, are really natural early adopters of EVs because, one, they can do the discounted cash flow to figure out that the savings on operations are worth that upfront cost and how many years it takes them to get it back, which is generally pretty quick. They often have vehicles that return to base at night, and they can install charging, and it's very powerful because imagine some community where there are basically no EVs, but in that town they start getting a bunch of EV pickups that do some work for the county or town. And so county doesn't have many EVs, town doesn't have many EVs. Most people are like, oh yeah, aren't those pokey little things? And then there's the guy who's like, oh, you sit next to him at the diner and he says, oh no, the acceleration's kind of crazy. It's really fun to drive actually. And that's really kind of powerful.
If I could just add on the EV chargers.
Yeah.
So each transportation bill has like a policy signature, right? So I would say the carbon reduction, resilience, and reconnecting communities are kind of the IIJA's kind of the key highlights there. So states are fully aware of kind of the expectations here on the EV chargers on the ground. Initial challenge, as I alluded to kind of a little bit earlier on, procurement of EV charging infrastructure all at the same time. Yeah, that just takes a little bit of time there. But the other thing we're running into is that state DOTs don't own gas stations, right? They don't really have the goal to then own EV charging stations either. So the states that have put in kind of the partnership, right, with the private sector, can you meet the NEVI standards? And yeah, they say, sure, to be part of this alternative fuel corridor national network. The 97% uptime requirement, for example, we're running into a situation
What
where
does that mean?
that the station has to be operational 97% of the time over a 12-month period, so that you don't go there and then it's dead.
Yeah.
But that's the kind of stuff where, oh, wait, you're not able to do that. So we can't build out our network then if you're not able to really meet that requirement. And part of it then it comes to, are they receiving federal funding? If they are not, what's their incentive? We gotta, I think, do a better job of the collaboration, communication, policy alignment in terms of the incentives there, as well as part of our, I think, kind of the learning curves and the growth pains we're going through right now.
Okay, I'm going to let the audience have a chance to ask questions before we run out of time. Tracy, and even though we haven't done this all day, when you ask a question, why don't you tell us who you are, where you're from? It's always nice for people to get a nice sense.
Hi, Tracy Gordon, Tax Policy Center. Great panel, thank you so much. A longstanding question I've had about big projects that span multiple jurisdictions, like the bridges that you talked about, or even EV charging stations. And I say this as someone who rented an EV in Vermont and was driving white-knuckled looking for a charging station, is that there's a lot of permitting that has to happen at the state and local level, especially with the power lines and all the things that Elaine mentioned. So the federal government can do the check the box thing and do all kinds of permitting reform itself, but what can the federal government do to expedite those decisions at the state and local level?
I mean, I think that's where organizations like mine come into play, right? Whether it's environmental permitting, whether it's kind of complementing the work that the federal government does so that each state doesn't have to recreate their own wheel, whether it's coordination of permitting, especially when you're moving like oversized, overweight, especially during emergencies and things like that. But I think, for what our members are telling us is that a lot of it has been kind of the layering of the various federal requirements over the years that I think if you were to take a step back, is that the most rational way to do it? Probably not, but that's just how things have been kind of, operating. But I think that's where the administration's lead is so important to kind of, refresh the decks here to be able to bring more rationality.
John, can I ask you and Sam, do you think that these bills have done enough to really deal with the permitting issues that, one where you're talking about, which is EV charging, I'm also thinking about EIS. Do you think that they're getting, environmental impact statements, just the whole process of getting a project environmentally thumbs up, which can be, a lifetime. Do you think that they addressed it enough in this, through IIJA?
So we had IIJA reforms, and John can speak to some of that. And then the administration also negotiated for some fundamental NEPA changes in the last debt limit bill.
The National Environment Policy.
Sorry, acronyms.
Sorry. So,
we are in a tunnel. Sorry.
Here's my key talking point, and then I do want to answer Tracy's question again the best that I can. So there is I think a kind of a false choice in the narrative that you can either build great projects or you can protect the environment, and we think that is, again, a false choice. We can do both, and the president has told us to do both. We can build really great projects, we can build more of them, we can build bridges, we can build semiconductor fabrication facilities, whatever FAB stands for. We can build transmission lines. We can do all of those things while being respectful to our communities and protecting our environment, and we are proving that out. We are getting EISs done in shorter timelines. We are getting EAs done. We are using categorical exclusions, which is the ability to really not do environmental reviews at all. We are sharing categorical exclusions between agencies. So some of what we're doing, Jeremy, is using what administrative powers we have, because some of this is just good management, right? It's transparency, it's accountability, it's just driving things forward and bringing people together. One of the cultural changes that we have tried to do through this effort is break down a lot of those barriers and silos. And so you have less of DOT saying we are only responsible for the DOT elements of a project, and more DOT now has a project delivery team, a major projects team. When the White House meets with them, when we meet with Secretary Buttigieg, the ask is, how is this project doing? And it's not just about how are the DOT grants and the DOT permits and the federal parts of it doing? It's how is the project doing? How is it doing?
Yeah.
How are we doing towards our shared goals of getting a shovel in the ground, opening this for people, actually getting it done, and moving, again, away from the kind of narrow visions of responsibility to something broader. We also have a lot of ongoing engagement with state infrastructure coordinators. So we asked every state, this was based on the model of the Recovery Act, we asked every state to appoint an infrastructure coordinator after the infrastructure bill was passed. Those are folks that are generally in the governor's office, sometimes they're in the state DOT offices, but those are the belly buttons who are thinking across silos, and that's been a hugely helpful and important opportunity. But then also we do lean on organizations like John's if we need to talk about two DOT secretaries, or there's a transit entity, there's a NASIO, which is the state energy officials. These are actually extraordinarily helpful fora for bringing folks together, and it also means that those people all know each other because they're together like every month or something. You have conferences all the time. And so I don't think there's a necessarily a technical answer, but there's a lot of kind of tools of art and also a culture change that we're trying to drive.
I'm not at those conferences, but I think that it's such an important issue you brought up. I think that the permitting is a big deal. When you talk about, you can get approved, you can get a project, you can win a procurement, you can go through your period of really negotiating the terms, you can have everything set, financing, the money's ready to go, and even actually, you can win the project and then go through a NEPA process for years. And so not only just getting through it, but as you noted, having a NEPA process, a permitting process that is applicable to the actual asset, I guess, or the dynamics of the assets, if it's a charging station. It is critical that we figure that out as a country, and just whatever that there's a line of like, we have to be stewards of our environment, period. Okay, there's a sustainability issue to everything. We also have to do things when we say we're going to do things, not waste everyone's time. And there's nothing worse than going through the process as someone that's looking to build a project, or someone that's looking to do something, and you're putting all of your risk in there, and the government doesn't have to act together, or they can't get things done. I'm not talking about the feds. I'm talking the state and local. Those that are procuring it because they haven't really fully processed the NEPA process when they've gone through procurement. So it's an important issue you get at that I think ultimately, if we're talking about assets and we're talking about actual delivery, very important.
Hi, Stacy Marr, Sustainable One. My question for these infrastructure projects, whether it's new construction or retrofitting, how much is climate resilience included in the planning process? And for how long, if it is?
Yeah, so climate resilience is incorporated in a couple different ways. So one is for the discretionary grants, so the grants for which state and local entities have to apply for them. Many of those programs have climate considerations in the kind of the competitive process. So in preparing your application, you have to describe how you're taking into effect both sustainability and also resilience into your planning. So that's kind of one area. There are also a handful of programs that are completely dedicated to climate resilience. So on the DOT side, there's a program called Protect, but we also have programs at FEMA, at Interior, and others that are all geared towards, everything you can think of: flood, fire, storms, heat. Really, every plague you can think of. And then the other area is around building those standards in. So there's something called the Federal Flood Risk Management Standard. You, I'm sure, know a lot about FFRMS. But for those who don't, there is a Federal Flood Risk Management Standard. It came out in the Obama administration. It was repealed in the Trump administration. It was reinstated in day one of the Biden administration. And different agencies are implementing that in different ways. Just last week, FEMA put out their new implementing rule so that all programs and projects that are funded by them are built to a certain floodplain requirement, and every other agency is implementing in one way or another. Jung, I don't know if you want to talk about how, like, on the ground level, state DOTs are thinking about resilience?
Absolutely. So the federal formula dollars for highways, there is also a requirement to maintain an asset management plan for the national highway system, which is the 220,000 miles of kind of your most important highways, including obviously the interstate system. And obviously, just based on the self-interest as an infrastructure owner and operator, state DOTs want these assets to last as long as possible. I think being able to kind of get the policy incentive push through the IIJA, through programs like Protect, both on the discretionary grant side and then on the formula side, we're just trying to, I think, try to fit that into the overall pieces of the puzzle of bringing so many different funding sources together to be able to actually result in a tangible project that, benefits a community. And I guess an example that I would bring in terms of figuring that stuff out, Protect formula dollars, one of the questions that we saw recently is that if you have like a culvert, I don't know, like yay big, and you got to make it this big, can you use the federal dollars to make a culvert this big? And one of the initial kind of things we got is, well, no, it's only good for the incremental change, incremental cost difference of a culvert this big versus that big. We're like, well, you can't just kind of tease that out and just do that, right? So that's the kind of stuff where I think the practitioner experience of our members inform how the federal policies, implement.
All right, we are out of time. Thank you. I hope you can continue your conversation after in our cocktail party outside, but please join me in thanking this wonderful panel.
Yes, thank you. So the drinks and snacks are in the room to the other side of the hallway here. Let me just remind you that two things. One is three things. One is we're going to start with breakfast tomorrow at 8, and the conference will start at 8:30. Sorry for the early start, but that's the cost of squeezing so much in. You can hold on to these things and bring them tomorrow, or you can leave them at the front desk and pick them up tomorrow, whichever suits you. And finally, once again, I wanted to thank Hao-En and Meg for such good service. Hao-En has been keeping everybody on time. And the RAs from the Hutchins Center for running around the mics and helping us figure out how to turn them on. So thank you all.